I get there, I'm going to do a quick seminar on money and credit, because you can't understand metals and mining and prices and investments unless you understand what money is. And I always start with an anecdote that a friend of mine led a delegation go see Janet Yellen when she was chairman of the Fed and asked her, "What is money?" And she said, "Well, I have 300 economists thinking about that every day." And I thought that was a troublesome answer, especially since Aristotle had pretty much figured it out 2,500 years ago. And he said that money began as a barter. One tribe bartering with another. If I have coconuts, you have fish, we make an exchange. The thing about barter is that you don't need to worry about the future. You get the thing you want right away. And what happened to money and what happened to monetary theory over the next few millennia is the realization that what you really want to do is sell your coconut if you don't want a fish, to have something you can maintain your value in, and then exchange for the thing you want at a later date. So what is that thing? Well, that thing has certain characteristics, and those characteristics are liquidity. So you have to know what the thing is. For example, a diamond is very hard to know what a diamond is, the 4 C's. I remember from when I got engaged, very difficult to determine. You can't cut a diamond in half. You can't put it back together again. And you think about that in comparison to something like gold, where because of its density, it's very easy to recognize. It's uniform, low melting point, very easy to transport because the value is so high per unit mass. The market depth is very large. You can buy and sell a lot of it without moving the price. And then it has other elements that keep its value steady through time. It's durable. Unlike grain, it doesn't get eaten. Again, it's low storage costs. It has a stable value over time and through time. That means that over long periods of time, the value stays the same, and the volatility is very low. And so over time, the monetary center moved from things like cattle and wheat, which were the first monetary forms, to copper, silver, and eventually gold once the market matured enough. And we got to a point in the early part of the last century where J.P. Morgan famously said, gold is money, everything else is credit. And what that means is that when you sell your goods for gold, you have pure purchasing power that retains its value over time, and you can spend later when you want to. So that's the monetary story. And then as J.P. Morgan talks about, everything else is credit. Well, credit is everything else. And so the way credit began is through banks funding invoices, in fact. So if you're a baker, for example, and you buy grain from the miller, right, you pay him in 30 days. You get an invoice, and the miller's stuck. He doesn't get paid. So he would take that invoice, that pre-sold thing, and monetize it at a bank. The bank would issue money against it. So if you think about a bank's balance sheet, it's advancing liquidity. It's not financing an asset. It's helping supply chains work. And that was the beginning of commercial credit. We still have it today. It's called factoring. And the bank really takes no credit risk and doesn't change pricing because it's simply liquefying credit. What happened in the development of banks was that eventually banks started financing assets, like your mortgage. Everyone in this room probably has had or has a mortgage. The bank lends against assets. And what happens then is that as the bank lends against an asset, before it pushes the prices of assets up. And once your house value goes up, your collateral is worth more. And the bank says, hey, I have more collateral, I have more balance sheet, I can lend more against real estate. And so they do, and real estate prices go up again. And this story should sound familiar because this was the story of the credit bubble, the housing bubble that everyone experienced between 2000 and 2008. Now, as that prices go up, right, in a free market, it signifies scarcity. And so what happens is people start building more houses and more commodities because if you think about asset prices and assets, you need commodities to build them. So credit bubbles have the feature of raising commodity prices, and that which creates overcapacity. Now, what happens in a credit bubble is eventually overcapacity leads to falling cash flows. When you have too many houses, too many mines, too many of those things, the prices go down. You can't pay your debts. The companies can't. The banks that forward the money are now insolvent, right? And they can't pay the depositors back. And so that's the crash after a credit bubble. And the way what the Fed was designed to do, if you read Milton Friedman, was he said, well, the problem with a credit bubble is that when the panic hits, everyone takes their deposits and they try to pull their currency out of the bank. And he said, what we need is a central bank. This is what the founders of the Fed said. This is what the monitors say. We need a central bank that can increase the quantity of currency to allow deposits to go into currency. And that's what the Fed did in the 20s, is what Bernanke did in 2008. And the problem is, of course, is that when the Fed starts printing currency, people get nervous. And they say, oh my goodness, the government's printing currency. I don't want currency more, I want gold. And so the value shifts from assets to deposits to currency to gold. And I love this quotation from 1932 from a gentleman named Garrett Gary. He said, the faith is lost. Always at one impulse, people rush to seize the gold itself as the only reality left. And what does the government do? Well, on May 1st, 1933, Roosevelt said, you can't have gold, it's a felony, you have to turn it over to the Fed. And so that was the end of the gold standard. In 2008, it was interesting. You could buy gold. Now, you couldn't go to the Fed and redeem your dollars for gold, which you could do in the 30s. What you could do, though, is go to the market and buy gold. And so the price of gold from 2008, the bottom went from 700 to about 2,000. In other words, the dollar devalued by about 2/3 in that episode. And that released the pressure from the system. And so that's the basic story of a credit bubble. I've given you a narrative from an Austrian economic perspective. The other perspective, monetarist, Keynesian, Marxist, they would give you different stories. What I'd like to do now is shift to some charts to show you that the data supports the story I've just told you about how money works and how credit works. And the first chart is the supply of gold. So gold is unique because it's not consumed. Unlike oil, which you burn, and copper, which you put in the house, you can't recover it particularly. Gold is used to store value, to store. So all the gold ever mined through history, most of it, still exists above ground. And so even though the gold mining industry, you can see, has a parabolic curve of increasing gold production, the industry globally only adds 1.5% to the above ground supply every year. Imagine if the Fed only increased the monetary base by 1.5%. We'd all be pretty happy about that. And so that is critical, not just because it stabilizes the value of gold, but also because if you think about what technology is, what technology does, technology lowers the cost of doing things. That's its function, to do things cheaper and better. And gold, unlike everything else, because the production is so small compared to the above ground supply, even if the costs of mining gold go down, you're only talking about the marginal 1.5% of the supply. When you go buy gold, you're mostly buying it from existing above ground supplies. And that means that the price determined by total demand versus total supply, unlike other commodities, which are priced at marginal demand versus marginal supply, because they're being produced in the margin, they're being consumed in the margin. So gold, the value of gold resists the lower cost of technology, unlike other commodities. And so what you'd expect to see, if what I'm saying is accurate, is commodities falling against gold. Think of it this way. In the 1950s, a car was a big hunk of steel. And if you've ever driven an old car from that era, you can almost see the gas gauge move as you drive down the street because they were so inefficient. And today, there's still steel in cars, but there's much less. And of course, iron ore mining, it happens at a vastly, vastly higher scale with vastly, vastly lower prices. We don't think of it that way because commodity prices have gone up in nominal terms. But this graph shows that over 300 years, the cost of commodities in gold terms, that's that black line, has been declining. And that trend line declines at about 0.8% per year, compounded for 300 years. That's incredibly powerful. Now, the blue line is what we're familiar with. That's the nominal price. It says, oh my goodness, the prices are going up. The world's running out of resources, right? We can't ever, we got to have green energy, other things. Well, no, actually, the cost of other commodities in terms of free market money, in terms of gold, is actually collapsing. And this chart shows something else about gold mining, which is that a gold mine, the way I think about it, is a spread trade. The inputs are rubber, steel, heavy labor, diesel, all those industrial inputs, and the output's gold. So what you really care about as a gold miner is the margin between the price of the commodities you use to dig it up and the value of the gold that you sell. So if commodities are falling against gold radically, this is a logarithmic scale, radically, what it means is that your cutoff grade keeps going down. Gold mines become more profitable over time. And history actually bears this out, because if you read anecdotes from mining 100 years ago, 120 years ago, the cutoff grades of most mines were around an ounce per ton. If a miner knew they had gold in the ground less than that, they would leave it behind. It wasn't profitable to mine. By the 1930s and 40s, you'd see miners mining around half an ounce per ton. That was because technology and commodity price had fallen off. You could get gold in the ground for that. Today, there are profitable mines operating at 0.5 gram per ton. And what I would tell you is that 30 years from now, they'll be doing 0.25 gram a ton if this continues, assuming technology continues to reduce the costs of everything, including commodities, it means that the margin of a gold deposit will keep going up over the very long term. Now, you may look at this chart and say, well, I'm being a little fast and loose. I mean, that's the trend line, but look at those giant bubbles. It's very volatile. Well, that's true. But if we look at where the volatility is, it's right where you'd expect it. It's during credit bubbles. It's during times when the government is spending huge amounts of money into the economy. So mostly during wartime, right? And what it happens is the government needs money to fight the war, so they float lots of bonds. The banking system buys the bonds, the treasury bonds, and they use the treasury bonds as collateral to do more loans. And again, here we see that in a credit bubble, as I described earlier, commodity prices shoot higher as against gold. So when you are in a credit bubble, which is most of the time, by the way, because most of the time the fractures of bank system is creating credit, gold is a terrible place to be because your costs keep going up in terms of your revenue, and that is not a happy place to be. So gold mining is a lousy business most of the time. But then, of course, you see these credit crashes like the 1930s, like the 1970s, which was an inflationary credit crash. And in those moments, gold is a fantastic place to be. So gold mining is really the real cash flows are very anti-correlated to the credit cycle. So it makes a wonderful thing to have in your portfolio that behaves differently from other assets in your portfolio. And so if you think about the relationship between commodities, gold, and credit, this next chart is rather sobering. This shows the credit levels in the three large economies, the US, the Eurozone, and China, and what's happened to them over the last decades. And you can see that in percentage of GDP, they've all shot tremendously higher. So the higher those charts go, those lines go, the more credit there is. Again, the more commodities go up in terms of gold, historically and theoretically. And so if we think that we're nearing the end of a credit bubble, a credit boom, and that lines are going to come down, and by percent of GDP, whether it's deflation or inflation, it doesn't really matter, right? That will set up a tremendous bull market in gold and gold mining stocks. Now, the Fed, of course, is designed not to let credit contract. That's its function. And so every time credit tries to contract, like the 2008 crisis, you can see the credit actually didn't contract at all. It went shooting higher as the Fed went in and manipulated the market. Well, how does the Fed do that? Well, we all know basic theory. The Fed goes out and they buy bonds, treasury bonds mostly, to re-liquefy the banking system and get credit going higher. The only problem is that they get diminishing returns on doing this. So this chart shows a chart of the federal balance sheet, the Federal Reserve's balance sheet, against an exponential growth curve. And you can see from 1960, they have followed the curve exactly, but not quite. 3 times they've tried to jump off that curve and said, oh my goodness, we don't want to print all this money. It's looking kind of scary. It looks like all those charts of Weimar Germany and all those things. We don't want to do that. So Bernanke, actually, when he became chairman of the Fed, the first he tried to do was stop printing the money so fast. And what did we get? We got the 2008 banking crisis. And they printed the money, hopped right back on that curve. And then we had QT, and no one knew COVID was coming, but COVID came, and guess what? The monetary base shot right back up onto that growth curve. And now we have the Fed saying again, we are going to do QT, there's too much inflation, we're going to stop printing the money, and we're hopping off that curve again. And already, it's only been a year, we're seeing the 3 largest bank failures, 3 of the 4 largest bank failures in US history have occurred since March. And more will come because as they try to shrink the monetary base, we're actually not grow it fast enough to maintain the credit bubble, banking systems will become under more stress and they will have to jump back onto this curve. And this is a very scary thing. And what's even scarier for me is that the Fed started off life buying and selling gold, then buying and selling invoices, commercial bills, and then treasury bonds. And what this shows is that it's not just the size of the Federal Reserve's balance sheet, it's the composition. So when they got going, the yellow and the orange there are gold and commercial bills and commercial invoices. And then the gray is treasury bonds. The dark gray is treasury bonds of 10-year duration or more, i.e. things that are very interest rate sensitive. And then mortgage-backed securities, which are hyper sensitive to interest rates, partially because the duration goes up when interest rates go up. So it's not just the size, it's the content of the Fed's balance sheet. And so if you think about what's happening to the Fed's balance sheet as they raise rates, they're having tremendous losses. They have operating losses because they have reverse repo facility where money market funds can park money at the Fed. The idea is to sterilize money. They don't want it in the economy. It's too inflationary. So they pay an interest rate on that. But their assets are fixed rate bonds. It's like SVB, right? So they have an operating loss as they have this mismatch between their income and their outflow. And then on top of that, they have massive capital losses because they bought these fixed rate bonds, and now rates are much, much higher. And so the Fed is effectively insolvent at this point. And the monitors will tell you it doesn't really matter because what matters is the quantity of money, how much money there is out there. But in my view, what happens is that the dollar is supported by political concerns. But the second that the market turns its eyes on the Fed, not just the bank, says, hey, Fed, what assets do you have to support the dollar? Well, that's when the dollar starts to become a very, very ugly story. And if you look at these are just a sampling of what happens to currencies when the central bank fails. And as you can see, the price of gold is very discontinuous. It's not nice parabolas. It goes along happily. The authorities are in charge. And then one day, the market says, okay, central bank, put up or shut up. What can you do to defend your currency? The answer is nothing. Then the currency falls dramatically. So in my mind, that is where the Fed is going. Again, not just because of the credit bubble in the private markets, not just because they're on an exponential growth curve of their assets, but the composition that they have to buy to maintain that growth curve is very, very troubling. And so the thesis for buying gold at this point is hard to ignore. And not just gold to protect against the devaluation of nominal currency, but again, that spread between industrial commodities, which is supported by credit growth and by asset construction, and gold that defines the miners. And the more marginal the mine is, the more it benefits by the spread increasing between the input costs of the production and the output of the gold. So I end my prepared remarks there, and I'm happy to take any questions from anyone who would like more details. Questions? Jim? Well, that's a great question. So the question was, what's the impact on this story for countries wanting to de-dollarize? And that's an excellent question because if you think about the U.S. Policy in terms of deficits, federal deficits, and central bank management, it's not that different from Argentina, right? But Argentina has 100% inflation, and we don't. We only have 5% inflation. What's the difference? The difference is, as you talk about, is that other countries keep the dollars as their own reserves, and so we print the dollars and they hold it in their central banks or in their private banks. And the euro-dollar system is built against the dollars. And so there's a huge credit structure built upon the US dollar offshore. And that has stabilized the dollar and also made the dollar purchasing power against foreign commodities stable. And that's key. What's also key is that much of foreign debt is denominated in dollars. And so what happens is when the Fed raises rates, all that offshore debt requires more interest payments. And so there becomes a huge demand for dollars as paper, not because of its value necessarily backed by the Fed's assets, but because the paper is needed to pay off those debts and not default. And so your question is, well, what happens if Russia and China and the BRICS and these other major countries with major commodity supplies say we're not going to take on U.S. dollar debt anymore? It's not so much the transactions, it's the debt denomination, right? Well, then the demand for dollars offshore goes down a lot. And again, I hate to make analogies of Weimar Germany because that experience was so intense and so much larger in scale and magnitude than where we are today. But one of the things that did happen in that episode was that the German mark was the marquee currency of the time because of the industrialization of Germany. And people bought a lot of marks offshore. And once the inflation got to a certain inflection point, all those foreign marks came flooding back into Germany. And then that got the hyperinflation into overdrive. So I don't think we're there yet, but I do think that there are a lot of offshore dollars that, under circumstances, could come flooding back into the U.S., and that would create major problems for the policymakers. Any other questions?
Anyone else?
Jeff?
Can you just comment on the discussion about every government having their own cryptocurrency and how that expands the fiat currency and how that will affect gold?
Sure. So the question is, well, I guess you heard the question about cryptocurrency, governments having their own cryptocurrencies. If you think about what paper money was and is, central banks got going because trading gold is very inefficient. If you show up in market with a gold coin, maybe you've clipped a little bit, maybe there are different denominations. And so in the as late as the 16th century in Europe, they'd weigh your gold on one side of the scale and what you were buying on the other side of the scale. And the original function of banks was you take your gold to the bank, they weigh it and assay it, and they give you paper. And the paper is better because it says, okay, this is a certain amount of gold, and the market can rely on that because the bank has said, we have it, and you can come get it. And so the crypto thing to me is not much different from that. The central banks are effectively saying, we're going to issue this thing. Instead of paper, it's an electronic record of a certain amount of value, right? And so it doesn't change any of the questions. Now, the monetarists would just say, well, like, all you need is a certain quantity of money and you're done. And so who cares if it's paper, deposits, or crypto, right? An Austrian like me would say, well, what's backing that thing? Is it just military power and tax power and legal tender laws? Is that what's backing it, politics? And so you have the same instability, or there are assets backing that crypto. So it changes the question technology, but doesn't change the fundamental question of what money is and how it functions.
I think we had 2 more questions back here.
Is there any signal you can look for that shows you that we're moving from high inflation to hyperinflation?
That's a great question. So the high inflation people can handle, right? We've all experienced it the last couple of years, and you still save your money. You say, okay, well, I need more money because things are going more in price. So I got to save more for groceries, right? So the first reaction is you need more cash because you know that your cash needs are going higher, right? Hyperinflation is an inflection. People say, I don't want this stuff at all, right? I'll buy anything to get rid of this cash and have just the minimum amount I can. I lived in Argentina at one point, and the way it worked when I was there, I wasn't there during a hyperinflation period, just a high inflation period, is you would go to the grocery store with a $100 US bill and you'd use it to buy groceries. You get the change in pesos. And that was fine. You use the pesos to buy your coffee, your newspaper, whatever you wanted to, but you didn't keep any value beyond petty cash in pesos, right? And so the inflection happens when that mental shift happens. People say, I don't want to store any value in this paper except for petty cash. My daily routine. I think we're a long way from it. I'm not a hyperinflationist. What I do think is we're on that path, and uninterrupted, that's where we'll wind up. But there are other things the banks can do. For example, they can shut the banks down, as we did in the 30s. Just say, okay, you can't. The Cyprus solution, right? We're going to eat your deposits at some level. The FTC's out of money, so yeah, we said $250,000, but we're going to make it $60,000. Why can't they do that? They did in 33. They took all the gold clauses and they said, well, we said we'd give you gold, but we're not going to. So they can do that. And I suspect that kind of break happens before we wind up in a Weimar situation. So I don't think we're going to go there politically. But that's certainly on the path that we're trending on. And it will require major policy change to do that. Is there one more question back there?
What happens if we get to that critical mass where China and the BRICS decide, okay, we don't need US dollars anymore, and they dump all the treasuries in the market at one time? What's the knock-on effect, say, in China and in the US?
Well, I think that's what happens eventually. Now, I don't think the Chinese want to do this. I mean, they benefit tremendously in the current system. I think they'll keep it going as long as they can. But there is an inflection point at which the costs of maintaining the dollar peg will be too great, and they'll abandon it on current trends. I mean, assuming the government doesn't become more responsible, which is a very bad assumption. So, I mean, what happens to the treasury market is it breaks, right? And we saw that a little bit, not from China, but remember back in September 15th, 2019, right before COVID, right? The shadow banks blew up, and the treasury yield for a brief moment jumped from whatever it was, 1% to 9%, right? Overnight. And the Fed had to say, oh my goodness, we can't let that happen. And that's when QE started. And it did not start again when COVID happened. They were already printing money at that point to bail out the shadow bank system because, as everyone knows, at 9%, the U.S. Treasury can't possibly pay its bills, right? And so it goes back pretty fast. And anyone with floating rate debt also gets eaten alive. So the Fed at some point has to decide: are we going to go buy the entire stock of Treasury bonds and keep the rates low? And there has been precedent. John Law in Mississippi Bubble, that's what he did. He went out and bought the entire stock of French debt to keep interest rates low. So there is historical precedent for that. But of course, what happened next was severe inflation. Or do we have some other, again, radical resolution where we just don't pay, we default, or we gate the bank system, we put in capital controls? There are other things they can do. But yes, that would be the end of.
All right, Dan, thank you very much. I know there was at least one more question, but if you can connect after the presentation, that would be great.
Sure.
We are about to get started. We're going to take a few minutes break, and we're going to get ready for our next speaker. Thank you very much.
Thank you.
And we're ready for our next presentation. Our next presenter is Sean Kuhn, Chief Executive Officer of Dolly Varden Silver Corporation, which trades on the OTCQX Best Market under the symbol DOLLF and on the TSXV under the symbol DV. Dolly Varden's silver and gold projects are located in British Columbia. Welcome, Sean.
Thank you, Bob. And I just wanted to thank the OTC for having us and hosting us, and for everybody who's attended this morning. I took over this company in February 2020, and the vision that I had for Dolly Varden, having been in the mining business, particularly the junior mining business for the last 20 years, I've helped companies through exploration, development, and into production. And what attracted me to Dolly Varden was we've got a project that is located in Northwest BC. And I'm not just saying this because this is my backyard and my home province, but this is a project and a jurisdiction where there is a clear permitting timeline. We've got certainty with our Indigenous partners. And because of the grades that are at not only the grades in the triangle, but we host some of the largest gold, silver, and copper projects on the planet. And what really struck me, and this goes back to 2016, I was looking at where am I going to focus my energy and my time, and what's the next frontier. This is an area that used to be covered by ice, used to be covered by glaciers, had no infrastructure, and yet for the last 100 years, we've had steady gold, silver, and copper production. And what's happened here in the last 7 years is the BC government has invested billions of dollars in infrastructure. So they brought in clean hydroelectric power into the region through the Northwest Transmission Line, which supports the Bruce Jack project, which was acquired by Newcrest a few years ago for $3 billion. So we've got power, we've got roads, we've got a deep water seaport, and we've got glaciers receding, ice melting, and we've got much higher metal prices. So I love this company and this opportunity, and it's a pleasure to walk you through it. So in this region, if we go back 5 years, this was a company where the average market cap was measured in the tens of millions of dollars. What we've witnessed here in the Golden Triangle is a reawakening and a flurry of M&A activity. So the $5 billion that we've seen through M&A has really sparked a resurgence. So the way we look at this area is this is a reawakening of past treasures. So if we go back and we study the history of the Golden Triangle, we go back to around 1920, where the famous Premier mine went into production. And the Premier mine was one of the greatest gold and silver mines of that generation. And then if we fast forward to 1989 with the discovery of Eskay Creek, which was, just the silver alone, we're talking 200 million ounces of silver at over 2,000 grams per ton. And it's one of the top 10 tier 1 gold mines in the development phase. So we've got a lot of positive things that are happening in the area. It's attracted the likes of Newcrest, of Newmont, of Teck, of Hecla. And, we've got the Premier mine that's going back into production, that's scheduled to be back into production Q1 of 2024. And so we are at the southern end of the Golden Triangle. And again, when I took over this company, February of 2020, we had a $20 million market cap. What attracted me to Dolly Varden was there was tremendous opportunities for regional consolidation. So the 4 deposits that are identified by the markers in the southern part of the property were in the company when I took it over. And now 2 of those deposits are past producers. So we've seen 20 million ounces of high-grade silver produced at this project. What I've done is I have done some regional consolidation. So we brought in the Homestake project, which is 5 kilometers north of our existing deposits, and we've now have 100% interest. So we have 7 deposits, And if we look at total resources in all categories, we've got about 1 million ounces of gold and 63 million ounces of silver. If we were to express that in a silver equivalent, it's about 140 million ounces of silver at close to 400 grams per ton. Now, what we're finding here is every 1.4 kilometers, there's a major deposit. And what you'll see there is there's a 5.5 kilometer gap where we consolidated the trend. So we're expecting to find more deposits in that trend. And the other thing that really stood out to me was these deposits have not been drill tested below 300 meters. So there's a tremendous opportunity at depth. One of the things I highlight on this slide is infrastructure. A lot of investors, they look at BC and they think, we're in the mountains of BC and there's a lack of infrastructure. But what I highlight here is we actually have a road from our property down to Tidewater. And the significance of that is we can barge in heavy equipment. So our costs are low. We can tie into the BC hydropower line. We can drive out to a regional airport. So this is world-class infrastructure. Now, I think in junior mining or in any startup business, the people are critical. And what I've put together here is what I would argue one of the best exploration teams. And I'm saying that, and we've got Peter McGaw in the audience, one of the greats. But we've got Michael Henriksen, Rob McLeod. Michael was with Newmont for 10 years as their head structural geologist. And we've also got the benefit of Kurt Allen, who's the vice president of exploration of Hecla. So we've got a technical committee that helps guide our management team and our VPX with our drill programs. Hecla is a shareholder. In the last 3 years, Hecla's been one of the best performing silver equities, NYSE listed. They're a 10% shareholder here at Dolly Varden. And I think one of the reasons Hecla's performed so well is because their mines are in safe jurisdictions. And it's, I think, one of the things that's attracted them to Dolly Varden. We're not in Bolivia. We're not in Argentina. This is a very rare company amongst a very small group of silver companies in that we've got a tremendously high grade project. We've got a large deposit. And I think, when I started this company, my goal was to make Dolly Varden a top 10 silver name. And where we are today is we're number 33 on the silver ETFs list. So, my goal to bring us in that top 10, we've gone from a $20 million market cap. We're valued at $250 million today. But again, where I think this opportunity lies, I think we have the potential to be in a 1 billion ounce silver camp. And I'll walk you through some of the drill success we've had. But before we go there, I think one of the reasons, our share price has performed well, and we've been able to grow the company, we've been able to finance the company, and we've attracted, whether it's institutions like Fidelity, whether it's investors like Eric Sprott, this is our foundation. We've got 4 shareholders that control 50% of the company. We've got a high level of institutional ownership. We've got great liquidity. We have no debt. We've got over $26 million in the bank, so we're fully funded. And I think one of the reasons we've been successful is we've been well capitalized. We've got some great research coverage. Michael Gray, who's been a great ambassador and shed a great light, not only on the Golden Triangle, but also in the Yukon, who's been early on names like Skeena or Western Alaska, covers us. We've got Jordy Mark at Haywood. And again, one of, I think, the strengths here is we've been able to do this and we haven't issued any warrants. So there's no warrant overhang. And moving on here. So in 2017, there was an organization that was started called the BC Regional Mining Alliance. And the goal of this organization is to let the world know that BC is open for business. So we've partnered with our Indigenous groups, the First Nations. In our case, it's the Nisga'a. We've partnered with the BC government. And essentially, what I'm here to tell you is if you respect First Nations, if you respect water, you get permits in a timely manner in BC. We just had the Blackwater project permitted by Artemis. Again, Skeena's been handed their permits in a timely manner, and as has Ascot. So BC is a tremendous jurisdiction. It's why from mineral revenues, we've seen a $5 billion growth. We've seen mineral revenue growth go from 10 billion to 15 billion year over year. And when I look at the future, BC is going to spend $650 million on mineral exploration. Dolly Varden represents about $20 million of that spend. So I think the future is really bright. So this focuses on our 15-kilometer trend. Again, I mentioned the 7 deposits. We believe there's a relationship between these deposits. We believe there's opportunities to extend these deposits at depth. And I'll walk you through some of the breakthroughs we've had. But this is a very important slide, because if we go back about a year and a half, we were trading at a fraction of the value we are today. We had a scientific breakthrough on site. We drilled below a sedimentary cap and we made a discovery. And the simple way for me to describe this for any non-technical investors is think of this sedimentary cap acting as a blanket over the area. So if you go back, production started in this region in 1919. And my point here is at a time where there was no roads, where there's no infrastructure, and a lot of ice and glaciers covering the ground, these deposits were still evident and they were highly profitable. However, the sedimentary cap prevented any previous explorer to look in this area. And when we drilled below the sedimentary cap, what it did is it opened up a new exploration corridor that goes from the Wolf deposit up to South Reef. It's the reason that I made the acquisition in the north, and it's a big part of the reason we've had so much exploration success. So we've got an image here, and what we're finding here is we're doubling the strike length of deposits, and I'll just highlight some drill holes. So we've got 1,500 grams of silver over 16 meters. So that is the best drill hole ever drilled on the property, and it was drilled just a few months ago. So in a 100-year-old mining camp, there's a tremendous opportunity here. So the goal in the 2023 drill program is, so I've just taken 5 drill rigs to site. They're mobilizing, they're getting the camp ready. We should be drilling by June 1st. We've got a 45,000 meter drill program. This is one of the biggest drill programs that the project has ever seen. And what my message to investors is, we've demonstrated we've been tremendous stewards of our shareholder capital. We've applied, we've moved in a very disciplined manner. We've raised money when equity markets have allowed it. We've conserved that capital. We've made accretive acquisitions. So we've grown our mineral inventory through accretive acquisitions. But now this next phase is going to be organic growth. When I look at leveraging the $26 million that we have in the bank, it's a heavy drill program. And I look at companies that are successful. I look at companies in Canada. I think of a company that like Great Bear Resources. There's no greater value creation than through discovery. And I think now that we've got 100% interest of this 15-kilometer trend, we've got a great understanding of the geology, and we're demonstrating it with these world-class drill results. Now, I talk about this company as a silver company because it's got an unusual, high-grade, a large silver endowment, and I'm surrounded by some of the greatest gold mines on the planet. But what's really highlights the opportunity here is these gold drill intercepts. So the best drill hole that was drilled in this area, and I'll reiterate the competition that I have in the Golden Triangle. I've got Bruce Jack, I've got Eskay Creek, we've got Premier, but Dolly Varden drilled 46 grams of gold over 25 meters. And so we'll be following up on the success we had up at Homestake. And this walks you through our broad plan. And again, what my experience in the exploration business is you come out with a high-level plan, and the simple plan here is we've got these 7 deposits. Let's continue to grow and extend mineralization, but let's also take some big shots. We've got areas of the property where we've got converging systems, and there's big opportunities to tag into a big SK Creek-like system or a Brucejack system. And again, I've got to hand it to my technical team, because as somebody who can transfer capital, as a my technical team are the ones that really create wealth for investors through their discoveries. So I think we're very, very, very well positioned in terms of we've got the capital, we've got the targets, we've got the team, and the big differentiator here, as I read reports coming out of Mexico of royalties, of moratoriums on mines, and I look at the left-leaning political moves in Chile and Peru, and the hyperinflation in Argentina, it just brings me a lot of comfort that we've got this project in safe, stable Canada that's demonstrating we've got this great foundational resource, but I think the real opportunity here is in the exploration. And again, we will continue to look regionally at growing this company. And again, ultimately, I think we're moving into a time in the cycle where the M&A activity will increase. We already have one corporate investor in the company today. And, I'm a firm believer in this business. Sometimes the hardest thing is to launch, is to get your company off the ground. And I think what we've positioned ourselves now with the capital, with the recognition of these astute precious metals investors, corporates, and having the alignment of our shareholders, our stakeholders, we're very, very, very well positioned to continue to grow. So I thank you for the opportunity to share Dolly Varden. Are there any questions? Yes.
Canadian US dollars.
So the target prices, everything that I've put up on the presentation there is in Canadian dollar terms. So when you saw that $2 target price from Geordie Market Haywood, that's in Canadian dollars. And I think the stock today is 93 cents Canadian. Here you go.
Sean, I just wanted to know, is it true that Rick Rule is one of the investors in Dolly Varden, and also Haywood? Are you at liberty to tell us the moving target price that they have on Dolly Varden?
Yes. So to answer your first question, Laura, Rick Rule is an investor. And has been very supportive of the company's growth. And to answer your second question, Haywood's target price is $2.
Thank you.
More questions for Sean? We have a virtual question, Sean, from our audience. It says, based on what you are saying, is there any strategic merit in a merger with your shareholder, Fury Gold?
That's a really good question, and it's an interesting question. I think right now, as I said, every decision I make for this company and have made in the last 3 years is this in the best interest of my shareholder? And I think right now, what's in the best interest of the shareholders is to leverage our capital and to drill. We've got to follow up on some big discoveries. I want to wrap my arms around how big this system is. So at this point, we're focused on organic growth. And I'll just because I do have a couple more minutes, I just want to end with a couple of ideas here. Again, I approach this a little differently. I'm not a scientist. I'm not an engineer. I'm here as an investor. And when I came across Dolly Varden in 2020, it was trading at 37 cents an ounce in the ground, USD. And the peers were trading at 75 cents. So I thought this was a no-brainer, with a little bit of awareness, with a little bit of love, the stock would double. The company would double because it was undervalued. It was very simple. But what I really thought is, because I've gone through precious metals bull markets, I've seen on average companies trade at about $3.30 an ounce in the ground in a bull market. And so I thought there's a 10x opportunity. Now, what we've done is we've tripled the mineral inventory. So we're trading right now at about $1 an ounce in the ground, but we've tripled the inventory. That's why the valuation's up. So if we continue to grow ounces either through acquisition or discovery, when we get to that bull market valuation, and I think actually that 330 is probably light, because the differentiator there, that's an average. That's an uneconomic, deep, low-grade ounce that'll never be produced in Bolivia. These are high-grade ounces. This is a project that's already been in production, that worked in 1959, that worked in 1919. So I am convinced, like, I'm not a founder of this company. I came in and I took it over because I saw an opportunity, and I'm just convinced that you've got these mining companies that are out there depleting their mineral inventory every day they're mining. This is a project where it'll be the next pipeline project for a mid-tier silver producer. And where we've really changed the narrative up at Dolly Varden is when I first took over and I was educating some of the Pan Americans, the First Majestics, the Fortunas. I had about 24 companies I could educate about what we're doing. When we brought in this big gold component, in addition to all the silver, we've got 1 million ounces of gold. Well, there's hundreds of companies that are interested in that. There are hundreds of companies that are mandated by their board to get into a safe jurisdiction, to get into Canada, to get into the Golden Triangle. And so I'm convinced right now that I know exactly what I'm going to do for the next 12 months. We're going to continue to attract more funds like Fidelity. In the last couple of months, we've had 10 million shares of buying come in from the SIL and the SILJ. And again, this is a business where when you've got momentum and you've got, more liquidity, larger and larger and larger investors can buy you. So I think we're really well positioned here. And I watched Skeena go from a $35 million market cap to $1 billion. And I think we're 15% of the way through our journey to realize value. So with that,
Sean, we actually do have one more question from the online audience. What are the key events from a drilling schedule standpoint that investors should look forward to over the next year?
I think what drives share price and what drives value is growth. And what's exciting is by having 5 rigs and 4 of them turning 24 hours a day for a long period of time, we're going to start putting out drill news, I would suspect in July, in terms of results, and lots of them. And we're going to continue in August and September and go on throughout the fall and into the winter. And we should probably continue to report until February. So from July to February, it's an opportunity with every discovery to drive growth for the company. And so, it's going to become a very, very newsy time for the company. And so that's what investors can look forward to. And again, we're always looking beyond our borders, and others are looking into our company. And so I think we've done a large M&A transaction that the market celebrated that was accretive, and we'll look for other opportunities. But I don't know if this company is going to be predator or prey. Either way, I think we've done a great service for our shareholders. From the moment I took over, I think the company's value is up about 500% for shareholders. The market cap's up about 15x. And I think, again, we're going to continue to try to drive that value for our shareholders. And it's as a result of having and I don't even talk about this, but this is analogous to KSM Brucejack. So, there's parts of this project that we haven't gone after, but we've got targets that we own 100% of that are KSM lookalikes. So, big gold copper systems, but we are focused on the low-hanging fruit. We're keeping it very simple. My geologist, and again, I think one of the breakthroughs that we've had, and this is a lesson that I learned, is not relying on third-party consultants. So what I did is I came in and I hired my own team, and I've got a team, a dedicated team year-round, and it's a large team now, and their mission is to extend and grow our deposits. My mission is to continue to get the story out to investors, large investors, good investors that are allowing me to build a business. And as a result of that, people are coming to me with great projects because they trust us. And I think we have the market's confidence. And again, it's easy when you're pulling drill holes like 46 grams of gold over 25 meters and 1,500 grams of silver over 16 meters. It's really the project that's shining, but we've got a really good technical team that's driving it.
So we have just under a minute. Are there any other questions from the audience? All right.
You mentioned that you own 100% of all your projects. Are they primarily, or is it a combination as far as underground versus open pit?
So
And if it is a combination, what will you develop first?
So our focus is on minimal land disturbance. So it's all underground. There is open pit opportunities. We're not focused on them. And one thing I should mention, so I thank you for the question. We've got a past producing mine that's got 7 kilometers of underground working. Those workings were rehabbed in 2017. So we do have the ability to go back and whether it's drill from underground. And again, just in that one deposit alone, there's 35 million ounces of silver. That's one of 7 deposits. And so if you factor in what's been produced and what's left behind, it's a 53 million ounce deposit at over 300 grams per ton. It's amenable to bulk mining. It's a big, wide ore body, and we're looking to replicate that and find more of those deposits on the property.
All right, Sean, thank you very much. I think we are at our time. Again, if you would like to meet with any of the companies presenting today, there is an option to meet one-on-one with them. I know Dolly Varden does have a pretty tight schedule today. But Sean, thank you very much.
Is from James Hesketh. He's the Chief Executive Officer and Director of Viva Gold Corp, which trades on the OTCQB venture market under the symbol VAUCF and on the TSXV under the symbol VAU. Viva Gold is a Nevada-focused gold exploration and development company. Welcome, James.
Yeah, thank you very much. Well, ladies and gentlemen, pleasure to be here today. We're going to talk about Viva Gold Corporation. As John said, it's a Nevada-focused gold exploration and development company, and we're advancing the high-grade Tonopah Gold Project. So our investment thesis is pretty simple. The project's located on the very prolific Walker Lane gold trend in western Nevada. We have a well-drilled, measured, and indicated resource and substantial exploration upside. One of the key aspects of the project that makes it unique is the presence of a high-grade starter pit. What that equates to is low capital risk. The higher grade near surface allows for the potential for in operation, very rapid payback of the project capital. We've completed a PEA. It was done at $1,400 gold. And that had a 25% IRR at the time. We will be starting another PEA this summer that will advance rapidly into pre-feasibility study. Got a highly experienced management team with a very successful track record and a strong institutional shareholder base right now. And we're looking at some pretty realistic timelines to move this project towards a development status. So looking at our current shareholding, our major shareholders include Dundee Corporation at 20%, Rab Capital out of the UK at 17.8%, Mermican Gold Fund. You heard Dan Oliver this morning. He owns 9.5% of Viva. And then Pontilis, that's a PE group out of Austin, Texas. They own 9.6%. So we have right now a very strong institutional support, and these are parties who do contribute on a routine basis to our financing. So it's helping us to move the project forward quite rapidly. So on our management team, our chairman, Chris Harold, very experienced geologist, former director of the Denver Gold Group for about 12 years. Anyway, one of the few exploration geologists I ever met who's been able to consistently over a 35-year period run a cash flow positive exploration company. Myself, by background, I'm a mining engineer and mineral economist. I've got my credit in my background about 8 different mine constructions and various commodities around the world. Steve Krause, excellent CFO. Andy Bolin, surprising director for a company of this size. Andy was formerly director of operations for Barrick Gold North America. In that role, all of the mines and plants in North America reported to Andy. Tremendous resource. Virtually every general manager in the state of Nevada has worked for him, so I can get onto most of the sites there, and it's very conductive for due diligence and discussions. David Whittle, strong background in small company CFO and CEO roles. And Ted Mahoney, who was also a former Barrick hand. He was head of manager of business development for Barrick Gold North America and chief geologist. So very strong back team with a focus on moving into an operating mode. Now, this chart here shows the location of our project, Tonopah Gold Project. It's the blue star. We're about a half hour's drive south of the Kinross Round Mountain mine. We're right on the road that runs to the Round Mountain. Just south of that, last year there was 4 acquisitions made in the district. 2 of them by Anglo Gold, 1 by Terra. They acquired those assets for between $65 and $75 per ounce of measured, indicated, and inferred resource. The key aspect of those acquisitions is that they were all fairly advanced projects, some of them with fully permitted status. The Reward project down near Beatty was acquired by Augusta Gold. Small project, about 320,000 ounces of reserve, proven and probable. That's a project that myself and my team developed and permitted back in 2012. We sold it in 2014. It was acquired by Augusta for about $90 per ounce, but it was a small project, but fully permitted. That's the value proposition for Viva, is we're currently trading at about $17 per ounce in the ground. And the key component that we have to do to unlock that value is to de-risk it, take it through the feasibility and permitting stage. And that's the real unlocking. So there's a potential there for, based on comps, anywhere between a 7 to 10% multiple or times multiple on the acquisition. But that's what we're working towards. That's the value proposition. So moving on, the Tonopah project, we acquired it in 2017. There was a very small resource on the project at the time, but a lot of drilling. It hadn't been properly characterized and had been studied in the past as a small high-grade underground. Now, the mineralization on the property comes to within 10 meters of surface, so we could never understand why the underground focus, except there are some very high-grade cores to the deposit. Approximately 20% of the tons in our resource base carries about 50% of the ounces. So we've got two different grade populations. One is a high-grade population, and that overprints a blanket of lower-grade mineralization. So that impacts the way we look at this project. Now, the geology here is fairly simple. We've got volcanics, tertiary volcanics overlaying an old rock. It's an Ordovician argillite. And the key takeaway from this slide is that the bulk of the gold mineralization actually follows the contact between those two rock types. That's the subhorizontal blanket of low-grade mineralization. And then we have, at this point, we've developed 3 potential pits on this site. The main pit area and the south pits, they're actually starting to combine as we do additional drilling. And then we have the Midway Hills pit. We've got a total strike length of mineralization on this property of over 2 miles. The width of mineralization is typically on the order of, let's see, I'm doing quick conversions in my head, but it's 300 to 400 meters wide. So you've got, what's that in feet? It's 1,200 feet. It's a very wide zone. The bulk of the mineralization, low grade, like I said, is subhorizontal. The high grade mineralization is near vertical. This is just a slide of some of our drilling from last year. The star of the show last year was the TG 2011. We drilled in that hole 58 meters at 5 grams, starting 40 meters below surface. So that's an example of what we see in our high-grade starter pit area is quite near surface mineralization that's high grade. And we do have a drilling program underway right now. We're on hole number 10 of the program and just starting to get assays coming in. So we'll be releasing assays probably initial in the next few weeks. What we're targeting right now, we have a series of, inside the main and south pit areas, we have a series of generally north-southish sort of splay zones. These are fault splays. And the mineralization, we're actually extending the width of those splays north and south instead of extending strike length. That's not our target right now, but it's to increase the width of the pit. And that is also acting as an infilling of the resource. Doing a lot of conversion of inferred to measured and indicated, and just generally upgrading the resource in preparation for taking the project into feasibility study. So this is a good example of a cross section. The hole TG 2011, that was the 58 meters at 5 grams. There was no drilling, no appreciable drilling to the south of that. It was wide open. So we've just completed 3 holes there. And that's going to be part of our next press release when it comes out. But we're seeing a increasing width potential along the pit strike length on this project. And that's good. It'll help to reduce strip ratios as we move forward. Now, on the long section, this is about a mile of strike length. This is the block model that you're seeing. Some of the mineralization very close to surface, under 10 meters of gravel cover. And then it dips down as we go west and dips down as we go east. So we'll start off with very low strip ratio and then moving to higher strip ratios over time as and that'll be after the payback period on the project. So it's well configured for a mining target. We completed a PEA in 2014. And if you see our node here, that PEA was completed on about 50% of our current resource base. So we've had quite a bit of resource expansion since that work was completed. What we described there was an open pit heap leach project, about $58 million in initial capex, $73 million over time. We did assume a full ownership of the equipment fleets there. That was purchased on a capitalized lease basis. About 72% gold recovery. That was based on column leach test work only. And we'll talk about the improvements to the metallurgy in just a minute. But that was about a 50,000 ounce a year producer that we described. Put it in context today, 50,000 ounce a year of gold production is $100 million a year in revenue. Pretty reasonable business concept. So looking at the sensitivities to that $1,400 case, at today's price of $2,000, it would, it's 67% IRR. Now, we've had some inflation in underlying capital costs since then, but I can tell you that my latest drilling cost, this year's, is 20% below last year's drilling cost. So the rapid inflation we saw in some of our cost structures over the last couple years is actually settling down quite a bit. And that's assisted too by a reduction in fuel price. So on the metallurgical front, the PEA was based on pure column leach test. Now, we took a look at that, 72% recovery. That's something that you need to take a good hard look at improving. And on our high grade population, 20% of the tons equaling 50% of the contained ounces. We looked at it using a 1 gram cutoff grade to come up with that number. In the higher grade material, if we apply an additional process step, keep in mind that's 20% of the tons, and that additional process step is after 3-stage crushing, which both the high and low grade goes through. We do an additional grinding step, and that goes into a vat leach for about 10 hours. And then that is forwarded onto a belt filter. The pulp from that is then blended back in with the pulp from that is then blended back in with the low grade, agglomerated with cement, and put on the heap leach. What that demonstrated was an increase of about 20% increase in gold recovery on the high grade material, or averaged across the deposit, approximately 10%. So that's how we're looking at achieving that additional recovery. And that process is done at a number of sites. It's being done at the Dolores Mine and Pan American right now. Historically, it was done at Ruby Hill in Nevada, Castle Mountain in California. It was done at Cripple Creek in Colorado. So it's a well-proven process, but that's what we're seeing, and it's amenable to projects that have these kind of dual grade populations, your low-grade blanket and then our higher grade structural controlled gold mineralization. So our next study will include that change. Now, infrastructure on this project, the road in the background, that's the road that runs up to the Round Mountain mine. We've got supply trucks, ANFO trucks, lime trucks, cyanide trucks, everything goes up that road every single day. So very active supply chain here. Coming into the picture, that's a chip seal county road. We'll have to relocate that one. It does cut across the deposit. That's a very low cost relocation. There's also a well field up that road that belongs to Tonopah Public Utilities. They've got substantial excess water rights, and there's a 14-inch pipeline that actually crosses the south end of our claims that we can acquire water from. We also have, following that pipeline, a 15 kV power line that's upgradable to 25 kilovolts under existing permits. So what we have on this site, commercial water, grid power, paved road access. We don't have to pay for all that. So you don't need the multi-million ounce deposit like you do in somewhere like the Golden Triangle, where you're going to eat up half the deposit to pay for the infrastructure. That's the difference. Now, what we've been doing on advancing this project towards feasibility status and permitting, we're probably getting close to being 90% done on all of our baseline studies. We've submitted our wildlife and fauna and flora studies to the BLM for review. We've been doing quarterly water sampling for a number of years now. Seep and spring studies, geochemical studies. We've updated the archaeologic studies on the site. And we've been doing hydrologic pump testing to understand the subsurface water aquifers and characters. So what we've done is prepare this. We've been de-risking, preparing the study, preparing to move into feasibility study. We've also been doing community outreach with the town of Tonopah and getting set up to move this project forward. So what we're looking at for projected goals and timelines, we're currently in the middle of a 3,000 meter drill program, anticipate about 21 holes there. We completed 22 holes last year, and none of those holes at this point have been put into the resource estimate. So we'll have about 40 additional drill holes to add to resource. We've had some pretty spectacular drilling results with those holes. Our metallurgical study, we're in phase 2 on the pulp agglomeration leach process. That's the metallurgical work that I described earlier. Our geotechnical study for pit slopes and all the information you need going to construction. The field work on that has been complete. We're just waiting for a pit design to actually complete that work. Baseline studies, those will be ongoing but nearing completion. And then we're ready to commence a feasibility study late this year. And we'll, like I said earlier, we'll be going through the PEA, the second PEA, and into the pre-feas on the way to the feasibility study. So doing all the steps. And what we would do is take that feasibility work and then roll it into initiating the environmental impact statement studies for permitting. And that is all part of the value proposition I discussed earlier, de-risking the project and moving it towards a development status. So, in summary, we own 100% of this project, well-drilled M&I resource, and we've been expanding it. High-grade starter pit, that's unique. We've been increasing the resource for a number of years, every single year. It'll be an open pit heap leach development, really low capital cost, great infrastructure, and we're in Nevada. It's a place where you can actually build a mine today. So that's the end of the story. Questions on this?
Jim, thank you very much. We'd like to open up the floor for questions. All right, hold on. One at the front here.
James, could you explain when you expect assay results? You made a mention that a press release was coming out shortly.
Yeah, it'll be within the probably the next month. We've got the first round of 7 holes, one in the lab a couple of weeks ago. So we do anticipate results shortly on that.
And then follow-up question, in terms of the PEA, how soon do you think you'll be looking to enter into that?
Yeah, we've been bidding that out right now, and we anticipate initiating that as soon as we have our final results on this drill program, and completion towards sometime in September.
I believe you mentioned that your costs were down by 20% versus a year ago. So the question would be twofold. Was it better quality mineral that you were driving through, or lower energy? And if so, what percent is energy in terms of total cost?
Well, in terms of a drilling program, your fuel costs are probably only about 10%. That is definitely down. What we have right now is there was a big shortage last year of labor, manpower available for drilling. There were drills available, but they didn't have crews to man them. Also, in our neighborhood in particular, Anglo and Terra were consuming a lot of drill rigs. They're running 25 to 30 rigs on their projects. And they've stopped a lot of that heavy drilling, and they're doing engineering right now. They're in feasibility, so they've cut back on their engineering. But overall, there's a greater availability of drillers, drill rigs, and the labs have also. Last year, I was getting a 10-week turnaround on assays. That turnaround has drastically reduced now.
James, we have a question from our online audience. It references revenue of $100 million, and when in the production estimate timeline is commercial production?
Look, if everything, I run a junior company, so it's all dependent on financing timelines are, of course. But if everything were to go, perfectly here, and we had full financing, I anticipate that we could move towards a construction decision towards the end of 2024. The EIS process is a 1-year process once you initiate it. There's actually a statutory timeline on it. Now, the BLM will not pick up a permit application until they're convinced that all your baseline study work is complete to their satisfaction. So that's why we've accelerated the baseline study work so that we can accelerate that timeline of them picking up the EIS process. So it all goes hand in hand, but this has been a several year, actually about a 3-year project management timeline scenario that we've been running.
You mentioned that your last drilling program increased the resource by 40%, and also in your earlier PEA, I think your CapEx was 58 million. Does the capital costs increase proportionally with the reserve increase, or do you get, what kind of leverage do you get?
Yeah, the resource was, yeah, we've increased it 50% since we did our PEA. But the really, in terms of if you get a larger resource, the tendency is to upscale the size of the project. And in engineering, there's something called the rule of sixes. So, you know, you take the ratio of the size differential and you raise it to the power of 0.6. And that's, so you do get scale efficiencies. And that's what we, that's why you try to build these mines bigger and bigger, you get better scale. But it's not a linear, it's a non-linear line.
Yeah, so you're probably the first junior I've ever had that's heard that said that they've been doing baselines. So kudos to you for accelerating the potential permitting process. So I have some questions about your baselines, and it's just two simple ones. In the state of Nevada, did you identify any special species or anything of that nature that could either create a larger mitigation problem or a longer timeline for permitting? And then the second question is on that same process. Are your open pits proposed to go to the water table for the same reason, accelerating permitting timelines?
Yeah, the water table in this area is fairly shallow. So the pits will go through the water table. And that's why I discussed the EIS versus the NEA process. You do get kicked into the full-blown environmental impact statement. Time differential between an EA and an EIS, you're really only saving about 6 months, but you also leave yourself with a greater exposure in terms of challenge. So regardless, I would prefer to go the EIS process. You'll save time later. That's number one. Number two, our field work, we did not discover any species of concern. We're outside of desert tortoise habitat. We're outside of sage-grouse habitat. We don't have historic mine workings, so there's no Townsend long-eared bats. You know, all the favorite hooks we don't really see, and we didn't see any species of concerns on the you know, the flora side either. So that encourage us, you know, that does encourage us to move rapidly forward. It's a great location, and you know, it's like everything else: location, location, location. And the land out where we're at, it's really lousy ranching country. It takes about 10 acres to grow a cow out there, and so if it doesn't get eaten by mountain lions first, you know, so it doesn't have a lot of beneficial use other than mining.
All right. Do we have any other questions from the audience? Okay, Jim, thank you very much for your time and your presentation. You will hear me say this many times today, but if you'd like to meet with Jim or Jonathan, feel free to find them outside. Feel free to find myself as well. And that goes with any of our other presenters today, too. Okay, thank you.
presentation is from Revival Gold. If you'd like a hard copy of the presentation, please raise your hand because we have some there. Our next presentation is from Hugh Agro, President and Chief Executive Officer of Revival Gold, which trades on the OTCQX Best Market under the symbol RVLGF, and on the TSXV under the symbol RVG. Revival Gold is pursuing gold projects in Idaho and a phosphate project in Utah. Welcome, Hugh.
Thank you, Bob. Thank you, everybody, for being here. I really appreciate it. It's a wonderful day in New York, and it's great to be in the city. And our stock price is up on the OTCQX market, RVLGF. The picture on the front of the screen shown here is our site in the western U.S. state of Idaho. That's where our project is located. 4 million ounces of gold in a wonderful part of the world. Cautionary notes. I want to start with why gold, and this picture describes it all. Gold has outperformed most other investments over the long term, and that is a consistent trend over the long term. You could look at isolated periods of time, and of course, gold goes up and down, but it is relatively low volatility and a relatively consistent performer. And why would you invest in a gold development project? I believe that this chart shows that answer clearly. The gold bar is the pace of gold discovery, running at about 10 to 20 million ounces per year. And the blue bar is the pace of gold production globally, running at about 5 to 6 times that. So since about 2011, we've been running at a deficit, and it's a growing deficit. And I believe for anybody who's interested in gold, gold development projects offer extra leverage and value, even if you don't think the gold price is going any higher from where we are today. Revival Gold was put together with that view in mind, put together a large, relevant gold project in a great jurisdiction for the future production that it offers potential. On the right side of this page, you can see a bar chart which describes discoveries in the United States. Bear Track Arnett, our project in Idaho at 4 million ounces, ranks as the second largest new discovery of gold in the United States in the last decade. Our project really has 3 differentiating aspects. First of all, that infrastructure that I showed you on the first page. Second of all, the jurisdiction. Idaho, a wonderful place to work, strong mining tradition, and lots going on there in terms of exploration and development. Thirdly, we've got a phased approach to this project. Rather than carve out one big, large development project with a lot of capital and a lot of infrastructure development, we've phased our project, much like the Australian model, such that we can produce gold from the existing infrastructure in a first phase heap leach, and then continue to build potential beyond that for a much bigger, longer life operation. In fact, our drill results are bearing that out, and I'll come to that in a moment, but our vision for the project is a plus 200,000, 250,000 ounce a year project with a plus 20-year mine life, and we're certainly making great headway toward that end. I'm not going to spend a lot of time on this slide, except to say that Idaho is a welcoming state, a long mining history, silver and gold, phosphate production in the south of the state, 30 million ounces of undeveloped gold in that state without a major gold producer yet landed. It's right next door to Nevada and offers some great opportunity amongst our peers. We've got companies like Perpetua, Integra, Liberty Gold, and of course, Revival Gold. Here is our land position narrowing in, about 14,000 acres. The left branch of the property we assembled in the first instance goes right back to the descendants of the first governor of the state of Idaho, himself a frontiersman and a miner. On the right branch of the property, the main mineralized trend, which you can see pictured in red along that blue strike zone of the fault structure. It's a 50-mile long structure, a large regional structure hosting a lot of gold. Infrastructure includes a power line running right through site. We're an hour's drive from a town of 3,000 people, which makes this an attractive place for domestic gold production. I mentioned that first phase production project. We are now in the final stages of developing out a PFS, a preliminary feasibility study for that project. It'll be 60 to 70,000 ounces a year gold production. We are working with some of the industry's best in this field of heap leach open pit operations on a brownfield site, relatively low technical and permitting risk, and the deposits are open. I've been talking about the infrastructure and how that's such a great advantage for us. There's really two reasons for that. First of all, it saves money. There's about $50 to $100 million of capital investment here that we can redeploy, recycle in a sense, for that first phase of production. In the background, an ADR gold production facility. Further behind that, we have the solution ponds. To the left, a core logging and storage facility, which is a geologist's dream for our team, and on the right, water treatment plant already ready to go and actually in use. These were mothballed in about 2000, but in good shape. We'll have to refurbish them as part of our restart plan, but that's not only a capital savings, but it's a head start in terms of our permitting and in terms of our development plans. I should point out that power in Idaho is largely hydropower. Of course, that's carbon friendly as we think about minimizing carbon footprint. I spoke about the upside on these projects. They're open. On our satellite project area known as Haiti, where we have an open pit resource pictured in pink on this page, we have a soil geochem anomaly up dip of that resource, which we've only got a couple of drill holes into and which we haven't brought into resource or fully explored yet. So this is a prime opportunity for us right next door to the existing pit, the existing resource. Beyond that, to the west, we've got some other target areas. And I'll show you in cross-section here with this picture, the original PEA or preliminary economic assessment pit shell shown in brown on this cross-section, the mineral resource shown in magenta, and the drill holes outside of that we've subsequently done and which will be included in our updated resource and in our PFS to come in about 2 months' time. Main point of this slide, deposit is open. And not just is the deposit open in the Haiti area pictured at the top of this picture, but we've got some other target areas shown in hot pink where we've got soil geochem anomalies, we've got coincident geophysics, and we've got rock sampling right into the rock, greater than a gram per ton gold in oxide mineralization close to surface. So lots of targets, lots of opportunity for us to continue to grow our target 8-year mine life in this first phase of operation at Bear Track Arnett. I want to talk about some of the deep potential on the project. I know we've got some great geologists in this crowd here, and some of them who have spoken and have had a lot of success in the past of looking for gold in the shadow of the head frame. I see Gerald Pendleton here. And of course, the detour was exactly that, the success in Canada where looking in the shadow of the head frame, a lot of gold was found. And here we are right next door to heap leach pads. We've got the strike of the main mineralized trend running right by our solution ponds, and we've been finding a heck of a lot more gold there. In total, we've got a 3-mile trend of mineralization, and we've hit with every drill hole into it. Some of that is shown in this cross-sectional slide here. You can see the open pit concepts from the mineral resource, which we put out a year ago. And you'll see a circled area on the left side of the chart, which is an underground target area that we've been focused on over the last couple of years, known as JOS. I want to point out before leaving this slide that there's a lot of high grade in this project area, including 10 meters of 71 grams under our Wards Gulch target, which we haven't yet fully followed up. So lots of targets. Again, we've hit with every drill hole into this structure, and the focus of late has been in this Joss area, which I'll come to now. So here we have about a mile and a half of trend from our South Pit target area to the bottom of our Joss target area. And this is a cross section, this is a long section through that drilled off area. The magenta color are assays over 5 grams per ton gold. This is a 100% gold project. I want to emphasize this is not an equivalent gold situation where we got copper or silver. This is 100% gold. And you can see what's labeled as the South Pit zone, that we've got the makings of an open pit there. But as we move to the south, we go underground, and we've got some beautiful drill holes coming in here, 20 of them in total to date. Deposit is open in all directions. We haven't fully tested between the South Pit zone and the Joss zone, but if we look more closely at that Joss area in a grade thickness visual, this is difficult for people to follow in detail, but I urge you to find the slide on our website and look at it at your leisure. The important point is on the magenta box to the left. We've got 20 drill holes into this, 45 meters of average drilled width, grading just under 3 grams. And within that, a high-grade core running 5 to 6 meters of just under 8 grams. And this is half a mile of trend in only 20 drill holes. Deposits open in all directions. A further visual here. We're in the Joss area, which I showed you a couple slides back, which is right in the shadow of that former leach pad shown on the left side of this page. In purple, you can see the trend of the mineralization. On the right side of the page, you can see the block model in section, which we put out a year ago, and the drilling beneath that, including the hole at the tail end of last season, which intersected 11 meters of 10 grams and another 11 meters of 6 grams, about 600 feet, 700 feet below the block model. This will be part of our updated resource coming out in a couple months' time as we continue to grow the deposit. Not just the ounces, but also the understanding of the high-grade potential. And we put more definition to the block model and the resource in the underground. And here's some of the core. I recognize that this is not a technical crowd, but this is nice core. When you get 19 grams per ton gold over 5 or so meters, that's pretty exciting for the geologists. More of it, drill hole 242, 17 grams per ton gold over 4.5 meters. Again, 100% gold. This is not a gold equivalent situation. And that look at that hole, that's within 3.5 grams over 115 meters. Even on a true thickness basis, if you assume half, you're still looking at something over 50 or 60 meters true thickness. And again, lots of horizontal continuity to this mineral deposit as well. And this is the evolution of the deposit. I mean, we went from founding the company in 2017 and assembling the land position to a maiden resource in 2018 of 2 million ounces of gold. In 2020, we came out with 3 million ounces of gold. And in 2022, a year ago, it was 4 million ounces of gold. And you can see the red shading is the mineral trend as it's grown. It will continue to grow as we put more drill holes into the deposit. I want to say one more thing, too, about our team, led by Steve Priestmeyer, our VP Exploration. The guys have just done a wonderful job. The deposit gives, but a finding cost of $5 an ounce, it really comes down to having an efficient team that works with shareholder dollars in a very careful manner. And that's illustrated in this finding cost, I think one of the industry's best. It's not to say we're always going to find gold at $5 an ounce, but I think it's pretty telling when the team has been able to deliver that consistently over the last few years, putting this project together. Again, not a slide for the non-technical crowd here, but if you focus on the key features of this style of deposit that we're in, an orogenic gold system, number one, they tend to be quite large. We've got a lot of significant large peers. Number two, they tend to have a lot of vertical extent. And remember that when I tell you that we've only drilled down about 500 meters, call it half a mile. The other thing is consistent mineralogy, which is of course important for recovery and economics. So these are very precious deposits to find. A look-alike analogy to what we've done with Bear Track Garnet and what we're thinking about for our second phase project is the Kittilä Gold Mine, Europe's largest primary gold producer, scaled for about 300,000 ounces a year. Same process, similar underground situation and grades, similar kinds of strikes and dimensions. They are down now about 1,500 meters, so 3 times the depth that we've drilled to date. Of course, there's a lot of interest in social license to operate. Those of us who've been in the mining industry, as I have for 30 years, have been focused on this stuff long before it became a popular trend. You do not mine today without doing right by your community, by your employees, and by the environment. And of course, we take those things very seriously. We've got an excellent safety track record. Last year, no lost time incidents. The year before that, no lost time incidents. Despite having upwards of 50 people working on the project in the season, we take that safety seriously. We also take the environment seriously. We've got state and federal awards for this project and a great legacy, a supportive community, and that's all important as we think about bringing this project back into production. And who is going to do that? Well, that's this team here. Our non-exec chairman, Wayne Hubert, was a director of this project, what is an operation in the finance group. He went on to found a company called Andean Resources, which was built up from 100 million market cap and sold to Goldcorp for $3 billion. I'm a mining engineer by training, president, CEO, and founder of the company 2017, and was part of taking Kinross from 1.7 billion to 17 billion before I retired in 2010. Came back to the business to do this because I really think there's a great opportunity for gold development in a safe jurisdiction like the United States, and with the project that we've grown from 0 to now 4 million ounces in the space of 5 years. John Mayer, our VP Engineering Development, Lisa Ross, our CFO, I mentioned Steve Priestmeyer, our VP Exploration, and Pete Blakely, our General Manager, based in Salmon, Idaho, the former General Manager for the operation when it was operating. All outstanding professionals and with great track record. Our capital structure, market cap today is about 50 million. We have a bit more cash, having just filled the book on a financing. So we'll be back drilling, and I'll have more news on that. Target prices on our share price is 4 to 5, upwards of 6 times where we are today. Lots of upside in this stock from where we are today. Building value in the gold business is about advancing resources to NPV. And a lot of us talk about finding gold and dollar per ounce valuations in the ground. But at the end of the day, as I think Jim alluded to earlier in his talk, we actually have to put infrastructure into these projects. We have to go about finding the teams to build them, and then we have to deliver free cash flow. And rest assured, our team is thinking about how we deliver free cash flow and how we do it efficiently for our investors. This slide describes that pathway as we move from a PEA on our heap leach through a PFS and FS on our heap leach project, then into an underground mill scenario, and ultimately to a larger open pit mill scenario. In terms of next steps, the key one for us is that resource update and that PFS that's coming in the next couple of months. Beyond that, we'll have news on our exploration season in the next month or two, and we'll likely be in drilling in the July-August timeframe. We've got lots of exploration targets to follow up on, and we're advancing our project through to a plan of operations and ultimately to recommence permitting from this site. That is our story in a nutshell. We've got a great domestic gold project, a strong foundation for growth. an advanced head start with our infrastructure and with our team and with our experience with this project. We've been finding gold at a rapid rate and at a efficient value for our shareholders, and we've got catalytic opportunities ahead. High-grade gold in the United States in a market that's currently trading at about $9 an ounce in the ground. Lots of upside in the stock. I welcome listeners to ask questions, look at our website, or contact us through the website. Happy to take questions now if there are any.
All right, thank you. First question here.
As you know, my favorite question. Tell me about your permits.
Thank you, Doug. Yes, so the first thing is we're on an existing plan of operations on the site. The second thing is that we will have to re-permit the site, but we benefit from all of that infrastructure. We benefit from all of that baseline study data that we have. And a key nuance of permitting is that when you go through that exercise, you have to look at alternative places for putting infrastructure and building your project. And of course, our infrastructure is already in place. So that saves us time and effort. We will have more details on the permitting timelines over the next, with the PFS, because we want to nail down the footprint of the disturbance that we will be making. But our target is to be through the permitting and making a construction decision in 2026 and through refurbishment of the site and construction and producing gold by the end of 2027. Now, there's a lot of things that need to come into place. First step is to get our PFS up. We'll nail down our timelines in more detail, but that's our ambition, and it's very much doable from this site.
With 4 million ounces in the ground, have you thought of raising money through a royalty or a streaming proposition?
Yeah, great question. Royalties and streams, a miner's dread. What we really want to do is advance the project with equity capital, and it's dilutive and it's painful to do that. But what's great about using equity capital is you're not under a credit driven process. You're not carving off pieces of the asset. And so we'll avoid doing streams and royalties as long as we can. And certainly we like a lot of the royalty and streaming providers, and they're interested in this project given the scale, as you point out. But we'd like to get our economics in place, have a clearer picture for capital needs for construction, and then we'll go and visit the loan sharks.
Are there any other questions from the crowd? All right, hold on one second here.
The PFS is going to come out in a couple months, and you'll be at an FID stage at the end of 2026, correct?
Yeah, FID
stage.
What is FID?
Final investment decision. Oh, whatever you said. Like the construction
decision. Yes.
Sorry.
Yeah, I just want to make sure I was understanding it. Good.
Okay.
Yes.
I just wondered if you look at your cash needs between now and then based on your business plan. So you have, call it half of 23, all of 4 or 5, and potentially some of 6 at the current. What do you think that is? Like if you were to add all of that up?
Yeah, it's going to be in the 10 to 15 million range, depending on how much exploration drilling we do, Canadian dollars. So really, the trick will be to toggle our exploration for where the market's at the time. So if we get a move in the gold price, if we get a interest for further exploration, we'll raise more money. It's a good question. We are going to need more capital before we get to a construction decision, no question. But what I'd like to say to you is that we'll spend carefully and we'll adapt for the market that we're in.
So, sorry, just to confirm, 15 million Canadian for the next 2.5, 3 years?
Correct.
Oh, okay, thank you.
Again, it's something. Our current burn rate, G&A, is running at less than 2 million Canadian a year. So we have some things that we can toggle in terms of how we spend money. And if we have to spend efficiently, well, we've proven that we can do that. So we will. If we're in a better market, and the environment is right to do more exploration drilling, we'll do a heck of a lot more of that because we have open targets.
All right, Hugh, thank you very much. As I've mentioned before, and I said I will mention again, if you'd like to meet with Hugh, you're welcome to find him outside of the conference room here. He will be departing for a few hours, but he'll be back this afternoon. And thank you very much, Hugh.
Thank you all. Hey, Raj. Hi.
Anybody interested in a copy of Gerald's presentation? Janelle has hard copies. Just raise your hand. Joe? Okay, we are, our next presenter is Gerald Penneton. He is the chairman and chief executive officer of Gold Terra Resources Corp., which trades on the OTCQX best market under the symbol YGTFF, and as well as the TSXV under the symbol YGT. And Gold Terra has gold projects in the Northwest Territories and New Brunswick. Welcome, Gerald.
Thank you so much. Thank you,
you.
John. Good morning, everyone, and thank you very much for coming to this presentation. I'd like to thank the OTC market for organizing, and I welcome everyone to listen to our presentation. Of course, in the world of gold, we can talk about gold and always find some more. It's always difficult to put that in production. So just for my reference, I've built 3 gold mines so far. 2 when I was at Barrick in Tanzania, and I was also the founder, CEO, and director of Detour Gold, if you know that little story, in Northern Ontario. Today, we're going to talk about a different story, Yellowknife, and my focus is high-grade gold. I'll explain a little bit more about why our strategy is like this. In the meantime, because we're a public company, you have forward-looking statement. You also have basically the cautionary statement, as well as our strategy. I spent many years exploring the rest of the world with Barrick for 12 years. So when I left Barrick at the end of 2005, I decided to focus mainly on Canada and the US. I spent some time in California on the Newcastle project that was purchased by Equinox. And before that, I was working very hard to build a Detour mine over a period of 8 years. And we'll talk a bit more about this. But our strategy today was to focus on a high-grade camp. Like the late Bob Smith from Barrick always told me, he said, would you not please spend your money next to the head frame because all the infrastructure are there and we don't have to spend more money to find something in the bonies? Because that's the problem. Re-permitting a mine is always a long period of time, depending where you are. You have political risk. Why don't using all the infrastructure that you have? And that's exactly what our strategy is. High grade, we are signed an option to purchase the Cal mine in Yellowknife from Newmont. We've already executed a lot of the the drilling over the last couple of years. We've been growing the resource, which was standing at 1.2 million ounces about a year and a half ago, now to 1.8 million ounces. But our focus is high grade. And the main reason when we talk about focus of increasing the resource at a low cost, like you said a few moments ago in this presentation, our cost is like $6 Canadian per ounce so far to add 500,000 ounces at 8 gram material near surface at the Cal mine. Because we're in town. Yellowknife is a 20,000 people town. And the town basically has all the infrastructure. Hydropower, of course, 20,000 people, 7 hotels. You know, everybody goes home at night. Everybody can grab a coffee and drive to the drill site, and the coffee is still warm. So you want to avoid helicopter, winter roads, and all these type of things, because I can tell you one thing. How do you evaluate a project? There's a trick that I've been using for many, many years. The drill costs. Ask the question, how much is your drill cost? How much do you spend on drilling? If you spend $1,000 per meters, it might be a little bit too far for mining, or it's going to cost you a lot of money. And I can tell you that there's a relationship between operating costs and drilling costs. No question. I've been doing this for 40 years. And I've been using this ratio when I was offered to purchase the Hope Bay Belt project from BHP. And back in 1997, 27 years ago, their drill cost was $350 per meters. 27 years ago. What do you think it is today? I don't want to know. Ours is $200 per meters in town at surface. And that's how you create value and you find ounces for a cheaper way. Now, the other thing I want to say about very briefly, what did I learn building Detour Gold? You know what I learned? Not to do one again. Because it's too big. Look at Côté Lake. It's twice the cost of what we built 10 years ago. Instead of 1.5 billion, it's over 3 billion now. And then you have to have the Achille of a low-grade deposit, not an heap leach. There's a big difference. Heap leach is a different animal. So this is a good solution to build heap leach. But in hard rock mining, with the crushing and the mill and everything else, and building the huge tailings dam, that's your Achille. You never stop paying sustained capital. There's no question in my mind. Now, moving into, you can Google me, you're going to find all kind of things, but you're going to find that I built 3 gold mines. I've been involved in the gold for 40 years. And, I'm still have the bug to find more gold. Look, Detour, I find 30 million ounces. That's not difficult if you know where to find it. And like you said, and like many other people, when we work close to where gold has been mined, there's a better chance to find more. No question. This is a district. We call it, it's like a gold district exploration. And that's why we find so much. So on those slides that you see on the right, you have a town, 20,000 people, and we're going to look at some of the stuff. I also have a friend of mine that have been working with me for 30 years on this slide. His name is Louis Dion. Louis Dion was Camflo mine manager under Bob Smith when Peter Mong bought Camflo mine to become Barrick. So I deal with people, and I know how to hire people to build mine. I mean, I don't have the team now because I'm not building. I don't have engineering working because I'm not doing a feasibility study, but that could change very rapidly. And the main reason why I really enjoy joining a company 3 years ago as a chairman, now a chairman and CEO, is because we control 800 square kilometers. I don't know what it is in miles, but roughly probably 500 square miles, right? 70 kilometers or 50 miles of the Campbell Shear. The Campbell Shear produce 14 million ounces of gold at grade between 16 to 22 grams between 1938 and 2003. The camp was shut down 20 years ago when gold was $350 an ounce. was completely underexplored or badly explored for the last 20 years until I showed up. Because if there's one thing I can do very well, I don't even need an analyst to tell me where to drill. I can tell you that. I know there's a lot of very good projects for you to choose for. You can have a very good project, but you better have a very good team to deliver. Because that's the most important thing. People will make things happen. The gold is in the ground. You have to prove it, define it, and that's exactly what we're doing. And of course, I work about 18 months to do a deal with Newmont to purchase 100% of the mine. It's an option that I have. I've already spent almost $8 million. And as you can see on this presentation, this is a shot from the air looking north with the trace of the Campbell Shear, which crossed the property, which mined approximately 5 million ounces on the Con mine, and the remaining of the site. There's a water treatment plant, there's a warehouse, there's also a shaft that goes down to 1,900 meters. So I'm going to show you some more slides later on, but remember this one. The Campbell Shear is your plumbing system. Gold is transported and precipitated along weak structure, shear zone, in different part of the world, and they go down to 5-6 kilometers. How deep is La Ronde mine in Quebec? You know, Agnico Eagle, old flagship, 3.4 kilometers. The similar project of ours, I don't have a comparable slide because the Vancouver Security Exchange will slap me. So I cannot put comparable when I present the presentation. But I can tell you that the best comparable is the island project of Alamos, where they're sinking a 1,600 meter shaft. Remember, we have a shaft that is 1,900 meters that can be reused. A little bit of geology, not too much, just to show you the trace of the shear zone. There's two shear zones, the Con Shear and the Campbell Shear, and they're both dipping very steeply to the west. 1 million ounces came out of the Con Shear at 20 grams, and of course, 5 million ounces came out. And we're going to look at the long section. For those who are not familiar with long section, it's just taking the geology or the mineralization into a vertical panel, projecting all the drill holes to depth, which basically gives you this image. You're looking west, north is on the right, south is on the left, and the deposit is dipping away from you. And this is where 5 million ounces at 16 grams was mined. Approximately 1 million ounces every 150 meters. On top of that deposit, it was the giant mine that was split off. So that deposit in reality is a 13 million ounces deposit over approximately 1,500 meters of vertical extent. Imagine I can find 1 million ounces every 150 meters. So where can I find 2 million ounces on this property? So I started at surface. That's what you can see. The red box on the left is my drilling over the last 2 years to find as much gold as possible, knowing very well that my best target is at depth. I did this on purpose because if I prove 1 million ounces at surface and I prove 2 million ounces at depth, my 1 million ounces at surface give me the first 7 years of operation near surface without having to go all the way down. That's a simple strategy. Get the money out of the gate first. And so we focus on the Campbell Shear, south of the mine. And so far, we've outlined about 550,000 ounces at 8 grams. And my target is deeper. This is another composite, a different composite, but the same information. We have all the information, all the level plan, everything is digitized. This is 5 million ounces that was mined, mainly the yellow, the red, and the purple. And there's a shaft. The black line that goes down is a shaft built by Cominco in the 70s. It's a 2,000 per ton shaft, 10 by 20, 10 feet by 20 feet. And it goes all the way to 1,900 meters. I met with the shaft man about 2 weeks ago in Orangeville. This is our third meeting. He was the guy looking after it. There's a lot of good people still around that will help redevelop this project. And they all there behind us said, this mine was badly shot in 2003 because of gold price. So this mine still have a lot to deliver. So we're drilling a hole. 2,300 meters depth below the mine. And you can see, I mean, do you think I can miss that thing? That would be very difficult. The shear zone is like 100 meters wide and has tremendous gold at depth. And one of the most important things is you're going to hear about Yellowknife. Oh, it's a refractory camp. And listen, everything in Nevada below the oxide is refractory. So you have to accept that fact that when you have sulfide, sometimes it's refractory. Below 1,000 meters, the con mine was free milling. The recovery went up to 95%. I'm going to show you why. Look at the grade on that section on the ground that was not mined. This ground, this area, was drilled but not mined because they shut it down too quick. 540 grams over 20 meters. That's what you mean, like we call it a jewelry pocket. We actually send the engineer and the geologist with their pack sack because we don't want that to go in the mill. We need to treat that almost separately. And when you look at the potential, of course, I'm not going to hit 500 grams over 20 meters in every hole. That's why you defend the lines. But the fact that there is this, you know it's rich. You know that's what you want. Because my strategy about high grade is very simple. Grade is king. A ton of rock is a ton of risk, right? That's why they have the letter R in front of each. But at the same time, it's not just that. Is that the more tons you have to move, the more risk there is. And when you do a low-grade deposit, your margin is like this. So you make money with volume. I prefer to make money with lesser ton and better profitability because when a miner said, I'm good, I'm very good. Yeah. You're dealing with nature. You're going to have problem. It's not going to be perfect. So if you have no margin to cover your ass, I'm sorry, my apologies for saying this, to cover your mistake, you will be in trouble. So looking at also past what we're doing now, which is $1 million hole that we're drilling below the mine, where I think we're going to have a 2 million ounces target. We also have 800 square kilometers. So even if the con mine didn't work, because we cannot find enough gold to purchase the mine from Newmont, that's part of the deal. We need to find 2 million ounces. I'm aiming for 3. There's 600,000 ounces left in the mine at 11 grams. So with 500 at surface, 600 in the mine, 2 million ounces, 3 million ounces. That's our strategy and our goal in 2023, 2024. Prove up 2 million ounces to purchase the con mine. Beside that, we would put the mill near the Crestarum deposit, which is already drilled off. 300,000 ounces at 6 gram open pit. That's I call a rich open pit. Don't talk to me about 1 gram open pit or below. So 6 gram could be the combination of taking the con mine and the Crestarum deposit, building the mill by the Crestarum open pit. We will be producing 150,000 ounces. And hopefully by the end of this year, when we have enough ounces, we will do a PEA so you can see the numbers yourself. But at this point in time, when you're valued at $10 an ounce, that's a good time to come in. Now, this is our discovery that we made in 2022. I didn't go back this winter to drill it more. We only have 1 hole, 33 grams over 3 meters. For us, it's great underground, rich zone. There's only 1 hole and it's barely 100 meters below surface. And just because the money supply is so tight for explorer and developer, we are just moving very slowly towards this. At the end of the day, we will. Look, everybody talks a lot about commitment on ESG, and I like that too. There's no question. I built 3 mines, 2 in Tanzania and Detour. So I've been through this, and the best thing I can say for ESG in a very simple way is listen to people. And when you come to an area, whatever it's in Nevada, California, or in Northwest Territory, or in Ontario or New Brunswick, you listen to your host. I'm a guest. I come to your town, I come to your city, I want to develop a mine. What can we do together to make it happen? That's the philosophy I have. And at the end of the day, this is what's worth. I couldn't run with it, by the way, it was too heavy. But this is the first goal of Detour. We built the mine IPO to gold pour in 6 years. I did not build the mine alone. I built it with people that I can trust, that I choose, and the team. We're not there yet. We're a very small company. We don't even have an office. We have an address in Vancouver. for $10,000 a month with accounting and things like this. We put the money towards the ground and to the finances. We're at a stage where I have to prove up 2 million ounces on the con mine to decide to purchase it, but the potential of the belt is north of 10, 15, 20 million ounces. It's been completely underexplored, and we look forward to questions.
I'd like to open the floor up to questions.
No question.
All right, Gerald.
Nobody was sleeping.
Oh.
You keep talking about this option once you get to your goal. How much you then have to buy the mine for?
$8 million cash payment, plus taking the bond from the environmental bond that currently is on the mine. It's a mine that was shut down in 2003. So when Newmont purchased Miramar for the Haut-Bébel project, they end up with the closure plan of the con mine. They never explored it. They've never looked at the potential. It took me a year and a half to negotiate with Newmont. And of course, it's a big company. I was at Barrick, so I know we tried to merge 5 times with Barrick over 10 years. So we're not going to go there. But I negotiated with them. I did the best deal. But I think we came to a common accord. I would not buy it if I don't find enough gold to buy it. That's the main clue. If I find enough gold, say 2 or 3 million ounces, then I have a project that I can develop. I want to use the shaft. I want to use the water treatment plant that is already on site. Probably will not put the mill back on the same site because it's in town. You know, these old town, mining town, it's like you're putting the mine and people build their houses around the mine. So, no, I think it's just a protection for shareholders. It's a liability to take on an old property. So if I find 2 or 3 million ounces and you give me a market cap of $100 an ounce, then we have a $300 million market cap, not 20 like it is today. It's been very tough. Look, I've never worked so hard for so little in the last 2 years.
And that would recover all your reclamation risk?
Well, the reclamation risk currently are $8 million. When you post a new bond, you probably will have to increase your bond if you have a project. But the main thing about the Newmont option is that I will not take this liability if I don't find enough gold to support it.
Okay, great.
So on your reclamation risk, does that also come with infrastructure that could accelerate some of the things that you're working on? I mean, you talk about being close to a town, but can you talk to the fact that you're on an ex-Newmont property? Is there core shacks? I mean, can you talk to that a little bit?
There's value of north of $200 million on this property. A 1,900-meter shaft costs today $120 million to sink. The collar is still in place. There's a warehouse, probably would cost $10 million to build today, that I can use full of equipment and spare parts, loaders, graders. All the mobile equipment comes with the purchase. And the surface right, of course, which is very important because with the surface right, I just need to change the activity nomenclature of the permit to go back on the ground. So I could go back very, very, very quickly on the ground, on the property. Now, not only that, there's a water treatment plant put in 2015, 8 years ago by Newmont, state of the art, to treat all the water that I pump to de-water the mine. So there are unquestionable value to this. But at the end of the day, if I don't find enough ounces to support an environmental liability for our shareholders for 10 years or 15 years to go, look, our strategy is very simple. We don't want to prove up a huge 500,000 ounces deposit. 150,000 ounces that makes money is better than 500 that has a low margin. And I think the infrastructure will be very helpful. And the fact that all the diamond mines are also closing in Northwest Territory over the next 10 years, they need new mining project. And you're in town, which is a big plus. Was that sufficient? Yes, good, thank you.
Gerald, we have a question from one of our online attendees. He's asking, what is the drilling budget for the next 12 months?
as much money I can raise. So the question is very simple: how much, budget it is. If today I raise $10 million, then I will do $10 million of drilling. As simple as that. The number of target being in a gold camp like this is not the question. It's just the money supply. The restriction is on money supply. And of course, we drill 12 months a year on the Con Mine because we're road access 12 months a year on all of the Con Mine aspect. And our winter drilling is mainly from January to mid-April. We build winter roads, but we keep the cost at $200 a meter, all in. My geologist lives in Yellowknife. The two techs lives in Yellowknife. We focus on investing on very good target. And I think we could be very successful in bringing so many new discovery in the camp. It's just a matter of time and money. One more question. Good.
So follow up on the how much money would you spend on drilling as much as you can get question. You're drilling a hole down into that shear zone. I'm not a geologist, but if you hit something good there, how many more drill holes on that zone do you think to help start pushing that case for that 2 million ounces in the deep zone?
The strategy and the model of drilling the deep hole is where can I find 2 million ounces or more on that property? When you look at the slide that I just moved, you're looking at 5 million ounces over 1.5 kilometers or 1 mile long, for example, going down 1 mile. So 1 mile by 1 mile, roughly. So you basically can find 500,000 ounces every 100 yards, right? Or 0.1 mile. I'm not sure if it's the correct conversion. When we look at this, we know the deposit is open. It doesn't stop at 2,000 meters. And there's no question when you look at this section, which is free milling, which is high-grade gold below the mine, we calculated that we can find 2 million ounces every 150 meters. Or 1 million ounces, sorry, every 150 meters. So our target basically is to have a master hole from which we're going to put 2 lateral holes, which will be 100 meters north and 100 meters south. And one of those 3 intersections will be the best one. And when you look at this slide, you can appreciate that the plunge of the deposit is subvertical. So the moment you hit a good zone, you stay in it. You just move up. We could have a miss in one of those 3 holes. The moment I have the 3 holes at the bottom, we do this. When this hole is finished and we've done all the wedges we could do, we do another one. Because we have 1 mile to cover, 1.5 kilometers. And that will give me 300 meters. So to explore it very well, truly, so we never come back again, we need to do probably 2 or 3 master holes and wedge about 100 meters on each side and then go up. Then that will allow us to cover the whole system, which is a mile long, on this project. But remember, we still have the Campbell Shear north of the Giant Mine and south of the Con Mine. We own the land. So there's tremendous potential along that plumbing system. Listen, it's like being in Timmins or Val-d'Or or Red Lake with no neighbors. I'm by myself with all those targets. But the only thing that slows me down is money supply. And you are investors that have looked through the panoply of number of projects, and you have to decide which project I like and which management I want to deliver. Because sometimes you can have a good project and bad management. So it's your call. My call is just to be transparent, honest, and tell you my story. Oh, there's a question coming up now. Oh, no. Because I only met you today. So the question is very simple. You're asking me, how come with a project like this you haven't raised any money? All the fun in if you look at the picture of institutional in the US and Canada, they're under redemption. They have collateral damage. USAA is gone. Wells Fargo is gone. Paulson is looking somewhere else. John Paulson used to be my major shareholder, 20% of Detour. So look, the last year, 2022, 23, has been extremely difficult for most of the junior. Raising money has been terrible. If you look at the press release, I tried to do a deal with BMO last Thursday. On Friday morning, they called me to say, we've got 3 million of flow through and almost less than $1 million in hard cash on the book. Do we do a press release? And I said no, because I would have told the market that I had 3-4 months to go with the hard cash after paying the fee for them, and they didn't bring any new blood. It's been very difficult. I've been working for more than a year to bring either a strategic investor or a strategic company that likes our project. They're watching. Some people, for example, in the last couple of weeks, they're watching for the result of the depot, but I cannot just wait for that result to raise money. Sometimes you have to do it when you need to do it. I'm not going to wait in mid-July to raise money, right?
All right, Gerald, we went from having no questions to not enough time to answer everything, which is a good problem to have, I think.
My email at the back of the presentation, you can send me an email. I answer every question of every shareholder, whatever you own, 1 share or 1 million.
And the good thing here, too, you are welcome to meet with him after the presentation.
Yes, I'm around.
Gerald, thank you very much.
Well, our next presenter is Jeff Swinoga, President and Chief Executive Officer of Exploits Discovery Corporation, which trades on the OTCQX Best Market under the symbol NFLDF and on the CSE under the symbol NFLD. Exploits Discovery is pursuing gold projects in Newfoundland. Welcome, Jeff.
Great. Well, thank you, Bob. So, and thanks everyone for attending today. It's a pleasure to talk about Newfoundland and exploits discovery. Who doesn't like Newfoundland, Canada, right? It was ranked actually one of the best places to do business recently by the Fraser Institute. Honestly, they had articles a couple of years ago saying we want to see 5 new mines in the province. So it's a tremendous jurisdiction. So here's our forward-looking statements, if you want to look at that at some point. And maybe just to start off, the gold rush that happened in Newfoundland happened about 3 years ago. It really kicked off with a company called Newfound Gold. And Newfound Gold had this incredible hit of over 90 grams per ton, over 19 meters. So tremendous gold hit. Everyone got really excited. Everyone started claiming land around the area. And you can see they're in blue in this chart near Gander. And there's also a company called Labrador Gold in green, but we're in gold around them. So we've accumulated one of the largest and most strategic land positions around Newfound Gold. And Newfound Gold grew up to become a $1.2 billion company. So very successful in drilling multiple gold discoveries. And we've got some very key land right around them. So I'll go through that in more detail. So we've got a strong management team. We have an excellent technical team, well-funded. We started off this year with about $10 million in cash. Great supporting shareholders. In Eric's broad, he owns about 19%, and Newfound Gold himself owns about 10% of us. I actually got the chance to talk to Eric about 2 weeks ago when he was in Gander, Newfoundland, doing his first public speech in about 3 years. So he's a big supporter of the area, and he's looking for big things. So it's great. So I guess the 3 things to remember is that we got great claims, great people, and we're looking to hit it big. Just on our capital structure, as I mentioned, our cash position, we've got 135 million shares outstanding. Some of the warrants, we've got 14 million, but those are kind of expiring fairly soon. Options are under 10 million, under 8 million. And you can see here's our chart. Newfound's got 10, Eric's got 19, and we've got a mixing of retail and some high net worth individuals and some institutions. So the key, I kind of brought this slide up to the front because it's very important. So we staked some amazing claims just late last year. You can see they're in yellow. So this is sort of a snapshot. If you looked at our large claim position, and we're focused now right around where all the recent gold discoveries have been by Newfound Gold. So you can see in the blue area there, all those great drill results that they had. And we happened to stake, we're very successful to stake the bullseye claim. Now, we call it bullseye because it's right on this Appleton Fault, right? That's where they're finding all the gold. And so it's right in the middle of all the action. And we beat all our competitors. It was just an amazing situation. My guys in Ghana were doing high fives and cheering when we got it last year. But we also staked the other piece in yellow off to the west. You can see that. And then we also staked another probably 8 to 10 kilometers on the Appleton Fault, just north of Bullseye. So tremendous opportunity for us. We're drilling it now. I'll go through it in more detail, but that's been a real game changer for our company. And beyond the bullseye, so if you looked at that previous chart on the map and then you looked at just the north, that's what you're seeing now. So you'll see bullseye right there. It's kind of like almost a bit of a speck. And then, as I mentioned before, Newfound Gold has created over $1 billion of market value just on a 5-kilometer stretch just south of bullseye. So bullseye is great, but everything in yellow is ours. And you see beyond bullseye, we've got another 18 kilometers on the north part of the Appleton. And the Appleton is the red line you see there. There's multiple faults going through. So we've got, the Dog Bay line, the Grub line, and so for the JBP fault, all these parallel faults. But the main fault they've been finding most of the gold is on that red line, which is the Appleton. Just a bit about our management team. I've been mining for about 25 years, started off my career at Barrick, Hudbay Minerals, North American Palladium, Torex, First Mining. I was national mining leader for EY for a couple of years. And then I jumped back in the sector because I thought this was a great opportunity, and it's been fantastic. Ken Tiley just joined us about a year ago. Fantastic individual, 35, 40 years experience running exploration teams, much larger budgets than what we currently have right now. I posted his, they joined us on LinkedIn. I got like 19,000 views, like a tremendous guy, great accolades. And Fiona just joined us as CFO recently, and Shanda, we called her the amazing Shanda, because things just kind of happen when she's around. She just makes things happen, and it's great. Doug Cater is on our board. He joined last summer. He was Eric Sprott's key guy at Kirkland Lake, where they bought Newmarket and then got access to the Fosterville mine, which is the most profitable mine in the world because of the super high grade there. So Doug was on the due diligence team with Tony McCooch to do that for Eric, and he's been a great board member. Larry Short is a very prominent wealth advisor in the province, knows everyone in the province of Newfoundland. Siri does sustainability work for companies, and she does a tremendous consulting company called Bridge. And then Rod does consulting work and valuation, and Chris knows the capital markets. And just on our technical advisors, we already talked about Doug. But David Groves, we follow a lot of David Groves' research. He's known as sort of the founder of orogenic gold. And orogenic gold is just mountain building the process when they find gold during this mountain building process. He coined that term back in 1992. He's one of the top earth scientists in the world. He's written 500 research papers. He's trained world-class geologists. He's just a tremendous individual. Peter McIntyre also helps us out. He's the former VPX, or VP of Exploration by Newfound Gold in the early days. And Gary Lewis was one of the key founders of the company to accumulate all the land that you saw around Newfound Gold. So great advisors. And here's our local team working hard every day. We got Nick Ryan, captain of the ship, Mark Christian, he's very creative and great geologist, as well as the rest of the team like Nathan, Brad, Paul, and Casey. And then we have our own key prospectors that are on the ground every day. So these guys are what makes things happen at our company, and very proud that they're all local. The only one not local is Mark Christian. He's at New Brunswick, but hopefully he calls Gander home. And so these guys are on the ground every day, working hard. And I want to point out one part on the bottom right-hand side. You can see the deformation of the rock. You see that's sort of at the micro scale of what you see on the ground sometimes in some of around the lakes and so forth. Now, if you look at the macro scale, let me explain what we're looking at, why gold has been discovered in Newfoundland. Back a long time ago, about 500 million years, it was an ocean floor. There was tectonic plates coming together, one going underneath the other one, causing pressure. And basically what happens, like a snow shovel, where one's going under, one's going up top, and it's actually pushing and creating folds into the rock. And then it creates pathways. And that's where these fluids are coming up with minerals like gold, for example, and then creating these parallel faults that you saw. All those lines you saw on that graph, those are the folds and the faults that we're talking about. And now there's so much pressure and so much heat in those black lines that you see. You don't necessarily find the gold in there on the fault lines. You find them in the tertiary, secondary folds. And that's where the heat drops, the pressure drops, and gold gets deposited in these traps. That's where we're finding the gold. And these are megastructures that go all the way from the US all through Ireland as well. And so this is a little bit about the research. So I talked about Dr. David Groves, and on the left-hand side, you'll see these parallel faults. So, and then you see these cross faults going through. So this has been proven in Australia, so it's a proven exploration model, and these 70-degree angles are very important. So the Keats, the big gold discovery that Newfound had, is like that bottom left intersection, because when the rock is kind of turning and torsion, it opened up traps for these fluids to actually drop gold into. So that's what we're looking for. And you see some of the core there. So at the Keats discovery, it's quartz, and you get the stylites in there with antimony, and then the same type of core they're seeing at Fosterville, the most profitable mine in the world. So we're talking super high grade in the core, and that's what we're looking to achieve here. So beyond bullseye, like we were saying, here's our land position in gold. And you can see, this is Dr. Dave Groves kind of drawing almost by hand, and we kind of work in parallel with a lot of the geologic structures that we have and advice that we have. These are the cross faults that we see going through the faults. And you can see the one below bullseye, there's a nice cross structure going there, and that's where they found the Keats. So along the other 18 kilometers to the north on this red line, you can see multiple cross structures going through. So we're very hopeful that we're going to find multiple Keats discoveries on that 18 kilometers. But we got to do the work. We're not drilling that part yet. We just got those claims, and I'll go through that. So let me focus on bullseye. So you can see to the south there, the discoveries that Newfound had. It's only 20 kilometers away from Gander. So, and then that gray line going through is the Appleton Fault, and we started drilling that. So, and then this is what it looks like from a drone footage that we took back in January. So you're sort of looking south and to the east a bit here. So the red is the Appleton Fault, bullseye, the sort of the upside down H is there. And just recently, Newfound announced 2 days ago that they found 3 new gold zones in that area. You actually can see the lines, that the drill sections that they were drilling back a few months ago, and they came out with 3 new gold zones. So the fact that it's kind of going onto our property at Bullseye is very exciting. So when we first got the property, of course, we got our permits, got our license, and we did very low frequency and mag on it. And so we weren't quite sure, because there's no fault that's actually as a straight line, right? It's like that red line you're seeing. So we only want to see exactly where that fault was going through. So that blue that you see is, we can say with confidence, that's the Appleton Fault kind of going through our property. So that's what we were targeting. So we started drilling, and we started drilling sort of where that sort of kink was you saw in the blue. And in our first hole, we hit gold, right? We had visible gold in our first hole. We had it in a few more holes, and then on our 5th hole as well. So we've released 6 drill holes so far, and things are going really well. So some of the results, the first hole we had almost 9 grams over a meter. You can see we're seeing flecks of gold into the quartz, just like we saw with Keats and Fosterville. We had a 14 grammer in there as well. Hole number 2, again, had visible gold, almost 5 grams over 3 meters, including a 16 grammer in there. And then hole number 5 was our best hole so far. We saw 5 occurrences, or 5 gold flecks in there, and that was only at about 28 meters of depth. So that had the highest grade so far of just over, just under 13 grams per ton over 3.5 meters. So, and then it had a super high grade of 68 grammer in there as well. So things are going really well. We're continuing to drill. That's our plan. We're going to continue to drill bullseye. Our next set of drill results are probably coming out next week, so watch for those. And then we'll kind of keep everyone updated as we get the assays from the lab. But beyond bullseye, we have a lot more lands I talked about, the other 18 kilometers, and that's what we're going to be targeting this summer. So you can see the shaded area here is what we just picked up last year, and we had this other area called gazebo. So we kind of consolidate all that, so it's now called gazebo. But we're going to be hitting this hard this summer. So we talked about those cross faults. We're hoping we're going to see multiple gold occurrences and opportunities along that fault line, and then maybe set up a drill program for the fall. So that's going to be exciting to watch, and the team's working hard. And beyond the Appleton, we have another kind of pipeline, if you want to call it, called the Dog Bay line. It's just one fault over. And we did a bunch of soil samples on it, and we identified 4 or 5 other gold targets there. So the key here is we're hoping to hit it big with bullseye, but then have multiple other gold discoveries that we can talk about along the Appleton fault and the Dog Bay line. So we're doing what we said we're doing. You know, we got our license, got our permitting, did our VLF, we started drilling, and the goal is to continue to update people with our gold assays, and then to advance our gold targets on the other lines as well. So it's a great story. It's a good time to kind of start watching us and stay tuned because we are drilling. We got great claims, great people, great founding shareholders in Eric Sprott and Newfound Gold, and yeah, just happy to answer any questions if you have any.
All right, we'll be opening up the floor to questions. Jeff, I think we have 1 or 2 from the online audience.
Hey, Jeff, the first question is of total expenditure. What % is spent on drilling and what % on salaries, et cetera?
Sure. Yeah. So about 80% is going into our exploration budget. So and the rest is sort of other things like G&A costs and other compensation. And so drilling, we're actually doing quite well in terms of cost for drilling. It's about $200 a meter. We're up. You know, we're going to probably drill up to about maybe 10,000 meters in total. So yeah, so the costs are very reasonable, and we got a great local drilling contractor. Yeah.
That same investor has a follow-up question.
Sure.
How long do drilling permits take to receive?
Oh, it's again. You know, the government of Newfoundland is great. We typically takes about a month to get a permit. You know, we've got a great local guy doing the permitting work for us. So he said our local guys are exemplary in terms of how they treat the land and how we're drilling, and we're really thoughtful in terms of safety. So we've had no issues getting permits. So we've been very happy. Yeah.
I assume there is no infrastructure in your area?
Oh, great infrastructure. Yeah, no, it's you can drive to the Bullseye site, for example. You know, it literally takes about 20-25 minutes from Gander. So it's the Canadian Highway is Trans-Canada Highway is there. So it's a local town of Appleton. So the infrastructure is really good. No, really good infrastructure. Yeah. Again, jurisdiction too. Yeah.
Another question from the online audience. What is the correlation between surface sampling and drilling results under these locations in the area?
Ah, interesting. So you know, it's hard to comment on others, you know, so I can only speak to what we've seen. I don't want to, so what you're looking for with soils is you're looking for, you know, the fire is hopefully where the soils, there's about, I don't know, 5 feet to 5 meters of till. That's glacial till that's on the island. So how the grains travel is interesting. So you might say, well, you know, if you find a hot spot and then you find gold grains sort of like smoke around a fire, right? So how do you trace back that smoke to the fire? And so you have to look at the glacial till and how it's moved, right? So so that's what we've seen. So we'll come out with some of our results too on any programs we do for soil. We did have some good soils results on the Dog Bay line, and kind of the smoke kind of led us back to those gold targets I talked about. But yeah, so there's glacial till. So you just have to monitor, be exactly, find out how the till was moving and how pristine those grains are going back to hopefully the fire. Yeah.
Another question from the online audience. They're asking about the relationship with Newfound Gold. Are they a passive investor, active?
Yeah, I would say they're
advisory role?
Yeah, no, honestly, it's I kind of view them as like Big Brother, because if you look at the work that they've been doing over the last 3 years, they've been very successful, of course, and so they've almost created the blueprint for us on the Appleton Fault and how to drill it. Because when they started drilling 3 years ago, they didn't really know what it looked like, what these splays would come off, like Iceberg and Keats and others. So they're continuing to learn about it, and we're actually have the benefit of that from their public disclosure. Like even coming out 2 days ago and talking about K2, Monte Carlo, and some of the gold zones they found just south of Bullseye. We're going to take that knowledge and apply it to our Bullseye claim as well. And then also to the other 18 kilometers we have on the Appleton, we're going to see how they were successful on that 5 kilometer stretch and apply it to our 18 kilometers. So it's around, everyone's very friendly. Of course, it's Newfoundland, so they're probably one of the friendliest people in the world, and so we have a good relationship with them. But they are passive. They're not. They don't have a board position, but yeah, they're great.
They're coming in nonstop.
Perfect.
Okay.
Yeah.
So somebody has a question about Eric Sprott owning pieces of Newfound, Labrador. Any talk of consolidation?
Well, you never know, but I think we're all working hard to as long as the work's happening on the ground, I think Eric will be happy. I did have a chance to spend some time with him 2 weeks ago, and he wants to see another big Keats discovery. And so that's hopefully one of the goals that we're going to be looking at, because again, just for reference, blue is Newfound Gold's northern property, Lab is in green, and we're in gold here. So we have a tremendous opportunity in front of us. The key thing is to do the work on the ground. Eric's been a great supporter, and he wants to keep finding big things. So we're thinking big, even though we've been successful with our drilling program so far. We want to hit another Keats. We want to hit something big in Newfoundland. So whether we're better together or apart, I think the key thing is keep the work going.
Okay. What are the turnaround times you're experiencing at the assay lab?
Not bad. We went with Eastern Analytical in Springdale, and they've been great. Turnaround times could be anywhere from 5 to 8 weeks. It depends what type of. Back about 3 years ago, when everyone was drilling, and we were drilling too a few of our targets, and we didn't get results for months. And it was tough, because you're drilling and you want to get the results so you can continue to find, and trace, veins, for example. But back then it was a bit tough because everything was kind of choked up because of all the drilling. Now it's a lot better. They've improved. They've expanded their lab. I talked to them 2 weeks ago, and they've done a really good job. So really pleased with Eastern. Yeah.
The next question is, are there likely to be any subsidiary metals, or is the ore only contain gold?
Yeah, this is primarily high-grade gold we're talking about. Yeah, so that's what we're focused on, and it's a great time. Gold's over 2,000, so it's a great time to be working for a gold exploration company. And yeah, no, it's great. Yeah.
And one more from the online audience, speaks to your capital needs, and when you expect you might need to raise funds next.
Oh, that's a good question. So we still have flow through that we were using for our drilling. Flow through is a Canadian sort of program to incentivize people to fund exploration companies, and they get a tax break. So we raised $4.4 million back in December. Eric put an extra $1 million in then, so we're continuing to use that funds. We will top up from time to time with some flow through. We do have a lot of hard dollars or normal cash. So yeah, but we'll top up from time to time.
And there is one more, and the investor's asking if you are using any new technologies for exploration.
Yeah, we're trying to use as much technology as possible, you know, a lot of data is coming in, and a lot of data is coming from our peer group, like we talked about the other companies in the area. So we're using everything available, and actually, what I like to see is you've got the David Grove's tried and true method. You know, he's been doing for probably 50, 60 years and training geologists, and then you've got sort of maybe some AI, and that's using over here with the old Gold Spot Earth Labs, and so. And then you got the local information that's coming up from our guys, and when things start triangulating, it's a beautiful thing, right? So we're listening to all the data and making decisions, best available decisions on what we can do for our drill program and for our exploration program in general.
All right, Jeff, I think we've exhausted our online audience. Does anyone else have any other questions here? Okay, wonderful. Jeff, thank you very much for your presentation.
Sure, yeah.
Again, if you want to meet with Jeff outside of here, you're welcome to pull him aside, and I'm sure he's happy to sit down.
Sure.
Thank you.
Hello. Our next presenter is Lauren McGaw. She is Investor Relations Officer of Reyna Silver Corp, which trades on the OTCQX Best Market under the symbol RSNVF and on the TSXV under the symbol RSLV. Reyna Silver is pursuing silver projects in Mexico and Nevada. Welcome, Lauren.
Oh, thank you for having me. And hopefully we won't get, well, we'll see whether or not we can get to a spot where you guys can get off to lunch early. The last thing I want is for any of you guys to become hangry, which is the combination of hungry and angry. Just to get it out of the way, my name is Lauren McGaw. Typically, when you see the last name McGaw plus the word silver, you're expecting the big man in the back. You can tell the difference between the two of us because I have better hair than he does. So, for one of the first times I'm getting to present in front of all of you, so it's lovely to meet you, as well as see some investors that we've talked to in the past. Reyna Silver is a company that focuses on high-grade, big-scale projects with what we refer to as an ore systems approach. So what we're doing is we're going into districts where something big was found historically, and we're not going to eke out the last little bit of that portion of the deposit. We're looking for the next piece, and we're doing that through a systematic, disciplined approach to exploration. Of course, we're going to make some forward-looking statements. It's important to do your homework and make investments based off of your personal research, whether it's in mining or anything else. So Reyna Silver has 3 projects that fit through our high-grade district scale filter, which is fortunate. We have an exploration team who has taken this ore systems approach previously and made some major discoveries, including our lead technical advisor, Dr. Peter McGaw in the back, who's co-founder of Mag Silver, and the team that's behind our projects as well, the geos who have the boots on the ground. That is the team that made discovery, alongside my father, discoveries like Juanicipio, Cinco de Mayo, Platosa. So that's the team we've got, and it's because of that team and our CEO, Jorge Ramiro Monroy, that we've been able to put together a well-balanced investor register, which has allowed us to have support so that we can have funding, because as you guys all know, junior exploration companies, our value is discovery-driven. Discovery is made with the drill bit, and that requires the support from our investors. So we have 3 projects: Batopilas, Gigi, and Medicine Springs. Batopilas and Gigi are in Chihuahua, Mexico. Medicine Springs is in Nevada. Batopilas is historically Mexico's highest grade silver district. It produced over 300 million ounces at an average grade of 1,500 grams per ton silver. Really crazy mineral deposit, considering the fact that the main ore mineral historically was native silver. So we went in saying, let's get out of the historic center of gravity of exploration, get into a new area. And when we did that, not only did we find additional high-grade silver mineralization, but we found gold. We found mineable widths and grades of gold that we were not expecting to see. And so as a result, we put a pause on drilling, said, let's figure out how this fits into the overall framework and see how we can leverage that gold mineralization to better understand the silver mineralization and hopefully find more of both. Our other 2 projects are what are called carbonate replacement deposits. We'll go into a little bit more detail what that is in a moment. But the moral of the story there is they're big, high-grade, large systems, and we're looking for the next piece. And in particular, in our Gigi project, which is at the heart of the Santa Eulalia mining district, which is one of the world's largest carbonate replacement deposits, produced 500 million ounces of silver from what we know of studying CRDs, the distal portion of the system. So we're looking for the other half of that spectrum. And so far, we've got a lot of work that says, yeah, we're getting close. The other project we have is Medicine Springs. That's in Nevada, so up north in the US, and in Elko County, which is a great address to have. There, we think we might actually have the full CRD spectrum. We did some reconnaissance drilling in the fall, and on our very first hole, we hit over 1 kilo silver, and we're really excited to be following up that drilling with additional drilling this summer. As I mentioned earlier, we have world-class technical advisors, including my father in the back of the room, as well as Doug Kerwin, who's famous for his discovery of the Hugo Dummett ore body at Oyo Tolgoi in Mongolia. Our geos, who are the guys that are boots on the ground, Rene Ramirez, Manuel Ruiz, incredible geologists in their own right, and our CEO is Jorge Ramiro Monroy, who comes out of Hong Kong, and that gives us access to capital that a lot of our peers don't have, which has allowed us to be able to raise even when the market has been soft. So, carbonate replacement deposits. You're hearing a lot about these, in part because when South 32 picked up the Taylor Hermosa deposit for $1.5 billion, people went, okay, that's intriguing. And it's because these systems typically are large, high grade. They're continuous, zoned, polymetallic, yet metallurgically docile deposits. And what that means is they're really scalable. And the way that these things form is if you see this pink blob down at the bottom, that's an intrusive. A style of intrusive could be something like a porphyry, which you typically associate with copper or gold deposits. Coming off of that porphyry is acidic mineralized fluid. It goes along structures and routes of mineralization, and when it interacts with the limestone, you have that paper mache volcano, vinegar, baking soda reaction, the pH changes, the goodies drop out, and this happens again and again. Another way to think about it from a non-geolingo perspective is if you imagine that intrusive, that pink blob, is like a bus terminal. Think of this like a public transportation system. So you got your bus terminal, and you've got the bus that's leaving along the routes. Those are like the structures. And along the routes, different elements are getting off in different neighborhoods. So that nice kind of red corona halo around the pink there, that's what we call a proximal scarn. That's like your downtown area. You got higher copper, gold, lead, zinc numbers. Your silver grade might be a little bit lower than the distal portion of the system, but these things are voluminous and they're large. As you make your way out along the bus route, when you get to what's called the chimney manto, so that's sort of that section over there to the right, that's like your suburbs, right? Your silver grade goes up, lead, zinc, they're a little bit tighter, but the grade can really shoot up. And at the very end of the system, that's where all the elements that fell asleep on the back of the bus finally get off. And as we mentioned, these are carbonate replacement deposits. So as the goodies are getting off the bus, the carbonate, which is calcite, gets on the bus along with some hitchhikers like manganese and lead. And why I'm even mentioning that is one of the components of carbonate replacement deposits is most of these big deposits were found in outcrop and then they were chased back. What we're now able to do over the work that's been done over the past 40 years is go after blind targets, because we can now identify near misses. And when we drill and we intersect mineralization, we can look around and go, oh, this is the neighborhood I'm in. These are the directions that I need to move to find the piece that I'm looking for. Why I bring that up and sort of spend a little time going into the geology behind what we do is to explain the style of projects that we're going after. So for instance, in our Gigi project, it is a beautiful case, as someone mentioned earlier, of the best place to look is in the shadow of the head frame. And the head frames in the Santo Ladia mining district produced 500 million ounces of silver, better part of 8 million tons lead and zinc, at an average grade of 310 grams per ton silver, and better part of 15% lead and zinc. This is one of the world's largest carbonate replacement deposit districts. And all of that mineralization came from that distal portion of the system, that suburbs and midtown, as it were. So the question at Gigi is, where is that bus terminal? And how can we leverage it against the historic part of the district? How can we work the two ends against the middle, find that downtown area, as well as look to see whether or not we have any additional suburbs coming off this thing as well, right? If you've got a suburb suburbs that have produced 500 million ounces of silver, I want to find that downtown area. And let's see if there's additional suburbs as well. So what we've done so far, because we're looking for something big, is at hole 28, I wish I had a pointer. At hole 28, which is sort of the biggest font there, up in the northern section of our property package, which is almost 4,800 hectares, we intersected for the first time ever an intrusive unit that we hadn't seen before. The bottom 55 meters of which is replaced by skarn mineralization that is beautifully zoned. Lead, zinc, silver, copper, another zinc stage. What that tells us as geologists is you're getting close. The question then becomes, which direction do you need to vector? So we went 650 meters to the north, 770 meters to the northeast, and over a kilometer out to the east from hole 28, and we intersected in all 4 holes. The same style of skarn mineralization at depth. That gives us half a square kilometer of footprint to work with. And that's what these pink blobs are down at the bottom. And one of the things that's interesting to us is sitting on top of that skarn mineralization is 1,200 meters of some of the most productive host rock for carbonate replacement deposits. Carbonate replacement deposits, you have a magic host rock. That's your carbonate, right? And when you have this massive limestone that we know has been readily replaced in the historic district, right? That spaghetti monster that you see to the left side there, that's about 1,000 meters of limestone, the green. And that big kind of L-shaped red thing, you can fit 2 Eiffel Towers or 1.5 Empire State Buildings sitting in there. So, big systems. And sitting in that, above the skarn, about 350 to 750 meters above, we're running into what's called feeder bleeder structures. So these are what are used in historic carbonate replacement deposit exploration, particularly in something like Santa Eulalia. They would run into one of these, and you get some silver mineralization and what we refer to as fugitive calcite. That's the calcite that got off the bus. And it tells us, hey, follow this, because these things are continuous systems. Follow this into those typical carbonate replacement deposit suburbs. So what we're doing right now at Geeky is following up on finding both these feeder bleeder structures and this skarn mineralization. We've been doing a big detailed geophysics survey. And what we're trying to do is design drill targets for this coming year that look both at your upper level structures as well as continuing to look for the source so they can work those two ends against the middle. Our other carbonate replacement deposit is Medicine Springs. This is in Nevada, in Elko County. And when you're out there, like the geos, it's like kids in a candy shop, right? Because of the 13 key features that we associate with some of the largest carbonate replacement deposits in history. Before our first drill hole, we saw 10 out of the 13. And to go into them a little bit, the first one, you have to be in an area that has intrusives. You have to have the chance for a bus terminal, right? And we're in an area near some big porphyries, like Ely, Nevada. And on top of that, you need the magic host rock. You need to be at the top of a carbonate sequence because you're looking for something for room to grow. If you don't have a big carbonate sequence, you can't have a big carbonate replacement deposit. That was actually one of the first questions that we asked in our recent drilling program. And we want to see high grade right off the top. Because we're looking for something big, we're looking for something high grade. The rest of these features are indicators that the bus left the terminal many times, and when it did, it was fully loaded. And that's how these things get big, that's how they get high grade, and that's why we look for these particular features. So there's these things called jasperoids that are at surface, beautifully structurally controlled, that have evidence of multiple stages of mineralization. And we went, these exhaust features give us a perfect window to what's going on at depth. So let's test them. We had almost 800 samples. And what came back was absolutely beautiful copper, lead, zinc, silver zonation. Our exhaust features, silver zonation, or silver jasperoid numbers, came back upwards of 400 to 1,200 grams per ton silver. So we went, okay, we want to test these targets. And we were doing reconnaissance drilling. So we wanted to see whether or not it was a project that was Reyna silver quality. Was it worth drilling here? So our first hole was designed to see whether or not we had the magic host rock. So we did a hole that was almost 800 meters long. And if you look there, everything that's blue is carbonate. So in terms of asking the question and answering the question of, is there room to grow? Check. The other question we had was grade. We went underneath some of these structures, and one of the things that came back in that first hole was 2.4 meters of over a kilogram silver. We then stepped out 1.75 kilometers to the southwest to an area that had never been drilled before, called Silver Butte, where we intersected 7.4 meters, 186 grams per ton silver, and 4.7 meters of 274. Why does that matter to us? It shows scalability on this project. So what we're going to be doing there this summer, after we do, we're doing an airborne geophysics survey, and we're going to be following that up with really defining those drill targets and testing them out this summer and see where that takes us. Our last project is Batopilas. This is historically Mexico's highest grade silver district. The main ore was native silver. I love this photo. That is 1 month's production in 1906. That's 350,000 ounces of fine silver. Each one of those is 25 kilogram bars. I would like to find where that came from. Produced that style of mineralization for over 300 million ounces of silver. Average grade 1,500 grams per ton. And what they would do is they would chase these little skinny veins of silver. And over the course of a couple meters, the structure would blow out to be 3 to 5 meters across, with a core running meter to 2.5 meters in the core. That was this crazy silver mineralization for 30 to 80 meters on level. They chased them for hundreds of meters down. In the 1850s, the US-based company came in. They said, let's put a tunnel in underneath these things and come up from below. And they kept going down. During the revolution, the mine closed down, the claims broke up, and it wasn't until the 80s that my father's group was able to, 80s, 90s, was able to put together the claim package so we could explore this on a big scale. Where's the rest of it? And so what we've done, this is an example of some of the silver mineralization. What we've done is where you see that purple kind of L-shaped jog, that's the Porfirio Diaz tunnel that I referenced earlier. And we said, that's the silver zone. Okay, let's go into these areas up into the northeast where we see structures, and let's do a trenching program. Is it worth going in there? And we came back with results of 305 grams to 42 kilograms silver. And then we also hit 21.4 grams gold in surface trenching in a district that had not seen gold mineralization before. We went, that's curious. And we drilled that. We came back with 3.2 meters of 703 grams per ton silver, as well as 3 grams gold. That's interesting. Followed it up to the northeast, where we intersected a zone of 36 grams per ton gold. And I say that after we did metallic screen assay to make sure that we weren't going to have to come back to the market and say, whoops, wasn't quite as high as we thought. And then as we came back down at hole 42A, we intersected 3.6 meters of over 8 grams per ton gold. So if you use a mineable widths and grade cutoff of 2 meters at 8 grams per ton gold, everyone do a little jingle. Now if you're finding mineable widths and grades of gold, you should probably figure out where that came from, especially in how it fits into the overall framework, especially because the gold mineralization and the silver mineralization are using the same structures. Probably not the same mineralized event, but because of that, it provides us with the exploration opportunity to use that gold mineralization to better understand the silver mineralization and leverage the two against each other. And so here's an example of the silver mineralization on the left, which is contained in calcite, the gold mineralization on the right, which is contained in quartz, so geochemically different. And what we've done is we said, let's do some sampling. In total, this is from the press release in September. In total, we've done 2,600 samples. So we're not messing around when we say we're sampling. Where we found additional gold mineralization. That's cool. What we've also done is a big structural study, as well as more detailed geophysics. We're putting those together and we're looking for the confluence of those 3 elements to determine our drill targets. And we're going to be starting drilling at Batopilas here real soon. So, to recap, catalysts. We got some good results. I had some great results out of Batopilas, Medicine Springs, and Gigi. We've then spent the time to take the data that we have, the drilling data, additional geologic data, because that's how you come up with the kind of strategic drill targets that you use in a disciplined approach to exploration. So we spent the last year doing that. And we're about to drill first at Batopilas, then at Gigi, or then at Medicine Springs, and then at Gigi this next year. And that should keep us plenty busy and keep our news flow going, and hopefully keep you guys interested. We've got 150 million shares outstanding. We completed a raise in February for 8 million. We're very lucky to have the support not only from existing shareholders, but new shareholders, as well as a couple of major institutions. We just finished having our first site visit out to Gigi the last about 2 weeks past. So hopefully we can expand our analyst coverage as well. So if you guys have any questions, comments, concerns, or jokes, feel free to ask. I'm still waiting for a joke. I've yet to have one. So
Anyone have any jokes to start the Q&A? Or Lauren, thank you very much. We'll be opening up the floor now to questions. Looks like we have one question in from the virtual audience. John?
You said next year for Juji to 2024. Why?
This next year, like 2023. We are, however, keeping an eye on where the market is. We don't want to be in a situation where we come too far down on the runway. And it will also be determined in terms of when we start drilling at Gigi based off of the results that we see out of Batopilas or Medicine Springs. But our intent is to start, whether it's fall or early winter, drilling those targets at Gigi.
You delineate the institutional holdings?
Yes. So Mag Silver, because those are where Gigi and Batopilas originated from. They have about less than 9% of the company. We are also held by Commodity Discovery Fund, Sprott, Terra Capital, Ingalls and Snyder, L1, and a little bit of Crescott.
Could you be more specific as to percentages? How much does Sprott?
Sprott is one of our biggest holders. I'd have to double check the exact number, but probably around 5%.
Can you talk a little bit about your financing? Obviously, you've got some great large projects here. When you finance, do you do target financing where you are, earmarking what you raise for a certain project, or is it one general lump? And how much are we talking about that you need to raise?
So we raised in February 8 million. We did that for all 3 projects with the idea that what we're doing is moving all 3 projects forward in tandem as part of a portfolio approach. So we don't end up in a binary situation where we make or break on a single project. And so our goal this year is to deploy that 8 million towards all 3 projects, the numbers being determined in part by the differential between drilling in Mexico versus drilling in Nevada. We'll be using it for drilling. So a target that would help, that would move us forward to raising additional money would be, potentially hitting some big mineralization at Batopilas or Medicine Springs that would suggest that we need to keep drilling and keep working off of the discovery. And that would potentially be a target, as well as, if we came into a strategic agreement that we needed to be moving forward.
You lose me on the geology, so I'm going to ask a different question here. High-grade silver. This is a big step back. High-grade silver.
I can follow.
What's the end market?
End market in terms of
Who's buying this stuff eventually, and why? Is it for precious metals only, or is it there's some functional use to it? I mean, distinguish between high-grade silver and lower-grade silver.
So we use it
from an end market perspective.
Yeah. So the beautiful thing about high-grade silver is in terms of the economics, right? We're looking for the kind of high-grade silver that when silver's at price is at whatever your personal nightmare is, you can still make money. high grade helps offset your all-in sustaining costs and offsets operating costs. We use something called Archie's rule, which was developed by Archibald Bell out of Noranda, that suggests that if you've got a project, your net smelter recovery should be at least 2 times operating costs. If you plot that out, you need to be north of 300 grams per ton silver. Okay, we use that as an idea. That's one of the determiners on our project selection. The other thing is that it's got to be big enough to survive multiple market cycles. So you can also take advantage of when silver goes to whatever your personal dreams are made of. In terms of end use cases for silver, it is both a commodity and a resource. So there's a monetary aspect to it, but recent projections show that it's also increasingly become useful. Where you see it a lot in photovoltaic cells for solar panels. There's biomedical implications as well as jewelry and store of wealth. So we obviously believe in silver. One of the other things that's beautiful, particularly about our carbonate replacement deposits, that Gigi and Medicine Springs projects. One of the things that's beautiful about those is that they are typically polymetallic, but where you can actually get good recovery on both your silver as well as your associated minerals. So in terms of end use case for this style of mineralization, we think that will increase in the future, both for resource as well as for commodity purposes. Did that answer the question? Beautiful.
Lauren, we have a couple more questions from our online audience. The first question is, what are the odds you find the same style deposits matching historical photos?
Oh, at Centralia? I mean, we could hope for that. The orientation perhaps could be different. Our goal right now is finding that source, because that allows us to work, instead of working from the ends in, it allows us to work from the center out. One of the big things that we're looking for is the skarn. And that is that more voluminous exterior portion that surrounds the intrusive, surrounds that bus terminal. The discovery of some of these feeder bleeder structures means that we've got a couple of shallower targets that we're going to take an eye on and keep an eye on. But the initial goal is looking for that skarn.
Another question asks if you have links, geographic or business related, to Rio Tinto or Albemarle with a similar structure to yours, and would you consider this in the future to add value?
Okay, I'm going to try to see if I followed that question and pull the pieces apart. I'm not familiar with Albemarle. In terms of Rio Tinto, they obviously have some very significant carbonate replacement deposits. Bingham Canyon. Resolution. So, potentially, we're very conscientious of the fact that as a small junior company, it's important to keep an eye on potential strategics down road, because it's hard to move big scale projects, especially when you have 3 like what we have forward. So, we'll keep an eye on going for strategics, potentially with a Rio Tinto or with an Agnico, or pick your company favorite. But our goal as of now is to move the company and the projects as far up the value added ladder as we can.
Any other questions from the audience here? All right. Excuse me. All right, Lauren. Thank you very much. I was about to say any jokes. Lauren, thank you very much for your presentation. As I've mentioned before, and I will say again, if you'd like to meet with Lauren, welcome to grab her outside and sit down in our conference area. Right now, we'll be taking a bit of a break for lunch for our in-person audience. To our online audience, you are welcome to tune in about 30 minutes. And we will continue with the conference. Thank you very much.